good.
Yeah.
Uh, as you have been saying, and what I'm noticing, and we're not flattening by any stretch of the imagination. Uh, we're still growing. The fact is that we're anticipating more stresses on the system because now the workforce is going to be a challenge. So
Oh, yeah. So you're starting to have issues with the staff getting infected now?
very much so. Roughly 5% are in quarantine at this point.
Oh,
So
man.
that's hard. That's hard because you've got a lot of people that are concerned for their own safety, and the PPE is the personal protective equipment is really key, and they don't see a whole lot of surge in availability, so that's a big concern.
So do you feel you guys have adequate masks and things of that nature for the staff?
For now,
For now, yeah.
yeah, but that changes by the hour. Um, Last night I was very, very concerned that we'd be running out in a couple days. So we alleviate some of that by borrowing from some of our sister facilities that are not hotspots, but we're seeing that countrywide at this point. So it's going to be hard.
And what about the age ranges and the
I really haven't gotten into that. I mean, the bottom line is what you've been reading or you've been talking about has held pretty firm. The testing is going a little bit better than what has been the case. We usually had to wait 4 to 5 days to get results. Now it's turning around within 24, 48 hours. However, we're triaging up front, and if you have a younger person, we're sending them home. We don't want them here because it's much more difficult for them to recuperate here than it is at home.
Yeah.
But now, my nurses and my medical staff, if they're high risk, they're being quarantined. And high risk, by definition, is their spouse has been tested positive.
Now, with the medical staff starting to become infected, when did that really start to become noticeable?
Actually, a couple weeks ago.
Okay. Now, have any of the medical staff ended up in ICU?
Yeah.
Oh, Lord.
Yeah.
And now, is your feeling that the folks coming into ICU predominantly have an underlying condition, or are you getting a mixture of?
Most have an underlying condition. It's not absolute, and I haven't really looked at the statistics or the numbers yet because I'm not privy to patient information per se.
Okay.
It would be a HIPAA violation for me to look specifically at patients, but I see the general reports and I can decipher based on the diagnoses, that whether they have a existing condition or not.
Okay, good to hear. Yeah, I also saw an interesting study. It was only based on 2,000 ICU patients. I'm not sure exactly which hospital. I'll go back and look at it. But there's almost zero ICU cases where the body mass index was under 18 and a half.
That's correct.
So I'm not sure just how skinny that is. But
actually, it depends on who you're looking at, but 15% is considered in pretty good shape.
Okay, so yeah, I was wondering if that stat was just because there's no humans with that low of a BMI, or if that was just a sign that.
No, women will be a little bit higher. Women will be in the 20-25% range. A man that's in really good shape is probably 15%.
Interesting. Okay, very good. Anything else you want to share with us, Oscar, before I go through the presentation?
Well, you hit a point right there on the obesity. Obesity is definitely a factor here.
Yeah. So that's a,
diabetes,
what
diabetes.
about with the African-American population having a higher relative
I don't
flow?
have that statistic. I just see, you know, I see patients. I don't see uh, what their racial makeup is. I know male, female, but outside of that, not much. And
Okay.
age.
And then you're having limited success with the hydroxychloroquine by the time they hit the ICU?
Uh, it varies quite a bit, and I can only tell you because of what my physicians are telling me.
Mm-hmm.
If they catch them early enough, it is very effective.
Yeah.
If they are too far along down the line, it's a non-issue.
Okay.
If anything, the president has done is made people aware of it, and they're more apt to present themselves a little bit earlier.
Okay. Very good. And I think that's really the big questions. And the average cost that's
Oh, it
occurring,
varies dramatically. I mean, uh, it varies dramatically. You can estimate about $2,000 to $3,000 a day.
and the average,
I've got patients here that have been here 2-3 weeks.
okay, but they're
And
getting
here,
discharged relatively quickly once they hit ICU.
no,
Oh
because
no.
now you almost need to get them with a negative test before you can discharge them,
Okay.
and so that delays the discharge.
Okay, good. All right. Well, thank you so much, Oscar. It's very useful to have some anecdotal on the ground evidence to hear it straight from the horse's mouth. So we all really appreciate that.
I've been called worse.
Thank you, Oscar.
Thank you, guys.
Yep.
All right, guys, I'm going to go ahead and go through my presentation and then go into Q&A. And
Jason, you want to do tell the group a little bit of background on just commentary from Oscar?
Oh, sure. So Oscar is a administrator for many of the hospitals in Florida, and he's been providing. It started off with me predicting all this would happen, and he said it makes sense. I see the data, but it's not happening here in Florida. And slowly but surely, that tune has changed, and it's not a sudden just rush. It's not like we're seeing this tidal wave of cases. It's just a slow. It's like you're watching the water slowly rise and just gradually become worse and worse. So that's unfortunately what I've taken from the information Oscar's provided us thus far.
Here, I wanted to add one more thing, Jason, and this is something to keep in mind. As more of these people are cut loose, and I hate to sound so bad, but cut loose from an employment perspective, they're going and standing in unemployment lines.
Oh yeah, I've heard people are turning down job opportunities because they're going to make more with unemployment.
Yeah, but they're standing in unemployment lines, and
and
who's
spreading.
to say the guy in front of you is not infected?
Yeah.
So that's creating a whole new mess.
All right. Well, very good. Thank you very much. I'm going to go ahead and go through my presentation. We're going to start off with a little analysis. We'll go through the trade alert, look at the news and charts, do Q&A throughout that period. I'm going to get the chat box open. So if you do have chats, feel free to post them as we're going, and I'll keep an eye out for any questions coming in. We'll talk about the stock market rally, how long it could last, predictions into the future, and we'll go from there. Okay, great. So I'm gonna go ahead and start off with my presentation, and I'll come back to the questions. And the medicine from note is called hydroxychloroquine. There's a few variations of it. It's some sort of drug that's been around for a long time that helps zinc penetrate into the cell, and it shuts down the mechanism that's allowing the virus to either latch onto the cell or take over the machinery inside the cell to replicate itself. And so I'll take a look at a bunch of stuff, guys, and then we'll go into Q&A. So thank you so much, everyone, for joining. I want to start off with this interesting model from a fellow. This guy is Dr. Paul Cottrell. Now, he's not a MD, so that's the first thing I want to disclaim. And you could certainly call him a tinfoil hat conspirator. He can lose his temper quite easily on YouTube. So that's sort of the bias to look for. He's not been wrong, though. That's what's interesting. And he's been on this since early January. In fact, one of the first things he pointed out was some research that actually got zero hedge banned completely from Twitter, and at the same time was removed from a bunch of medical sites. And this was some articles insinuating that this could have been created in the lab in Wuhan. So that's when I first started listening to him. He is very open-minded in terms of who he'll interview. So we definitely got to take what he presents with a grain of salt. But with that said, he's been extremely accurate in predicting the future well before it's occurred. Now, here's a model he put out yesterday. And I think he may have this wrong. So I just wanted to look at it and go over these outcomes and how this could play out in the markets. So the bottom line is that we have a virus that's slowing down our economy. So that's the basic hypothesis, is that the economy is going to slow down. So the profits and earnings of companies are going to drop. So that's part one of what we have to understand about what's coming up in the next 12 months. That is certain, but the depth of this drop in profits and revenues is really anybody's guess. We don't have data. We don't know how long this is going to last. We don't know how consumer behavior is going to change. But from that perspective, it's quite clear that GDP is going to be highly negative. The second thing that we can really predict with great accuracy is that the government's going to have to bail out the private sector, which is going to create massive growth in deficit. And so in the bond market, really, we want to bet big on bonds if we think there's going to be acceleration in the growth of debt at the government level. And in the stock market, we're trying to presume that there's going to be an acceleration in growth in corporate profits. So that's the basic 10,000-foot overview of why we're positioned for a rally in bonds and a bear market in stocks. Now, where does gold play into this? We'll go over that last. I do think that gold has some lag before it takes off to much higher levels. And we'll look at why in a moment. So the big forecast I really have for investors is that the stock market pump and dump we're looking at right now, fueled by basically free credit to every institution, is really just a cue for the CEOs to get out, the big insiders to get out with every penny they can before all the bad economic data comes out. And that bad economic data most likely is going to last for 12 to 24 months at a minimum. And we'll take a look at why. Okay, so that's really the big picture. The next thing we need to understand is what's causing this economic destruction? And so we all know what it is, but how bad will it get? And so he's created several models. And the big problem is that the children pick up the virus without even knowing they have it. They pass it to their parents. Parents may get sick, but they may not. In fact, most people don't get sick. In fact, the average statistic is that 8 out of 10 people will have no problem dealing with this health problem all on their own. It's just the 2 out of 20 that's causing the economic destruction and forcing us to go into lockdowns. Okay, so that's part one. Part two is that it's highly contagious. And in fact, some PhDs in Los Alamos, which is here in New Mexico, that's where they built the hydrogen bomb. And my grandfather is actually the head of that. So I do know there's some pretty smart folks up there in Los Alamos. They calculated that the average person who gets this virus will spread it to 6 others. Now that's when we have society operating normally. The whole purpose of these lockdowns is to drop the spread and to slow down the growth of the virus. So we come to a predicament where if we want to save lives, protect our medical system, it comes at the cost of shutting down our economy. But if we shut down our economy, we all go broke and starve to death. So at some point, we do have to push everyone back to work. So what's the solution to this? Anyways, in this model, he has looked at a prediction and he's been saying this all the way since January with these different crash predictions. And so he's ascertaining that if we can deal with this in 6 to 8 months and only infect 2% of the population, that we end up with, this based on 330 million Americans, that we end up with 1 million hospitalized spread out over 8 months with 250,000 deaths and an S&P 500 at 1950. Which is also very close to what the healthcare officials are now pitching us currently. Okay, so I think he's got this flipped. And in general, I believe to end up with 2% being infected, right? Right now, I'd estimate we're closer to 0.5%. At most likely 0.5% of the population currently has this. So 1 out of 500. It may be worse than that, but I would doubt that it's more than 1 out of 100 Americans currently have it. So we're already close to that number. And we just went into a quasi lockdown. Now, the only way I believe we could really achieve this is if we can get a vaccine to everyone and keep the country locked down until a vaccine is ready. Now, right now, timelines on a vaccine, which oddly enough, Bill Gates has somehow elected himself the leader of this whole operation and is funding, and he's been doing a lot of good things for a long time. So I'm not going to speculate on Bill Gates' intentions, but at the earliest, I would expect we could have a vaccine rolling out next summer. A few catches to the vaccine is that we could not solve SARS, which this is highly related to. We did create a vaccine, and unfortunately, when you gave it to a mouse, it created the antibodies. But when you reintroduced the virus to the mouse, it had an autoimmune system failure. So the immune system just killed the mouse as it was not able to deal with the reemergence of the SARS. So we currently have a whole bunch of vaccines, I think about 7 underway right now with lots of different strategies, all of which I would believe can create the antibody. But that does not mean that we can turn it around and have a vaccine that works for humans. So that's a big risk, is that we can't actually come up with a vaccine in the near future that I think is being underpriced currently. That's one. 2, in the best case scenario, we have to keep the economy shut down for at least 12 months or severely shut down to keep the numbers this low. So I'd actually argue that your worst case scenario would come at the cost of saving the most lives. And the best case scenario for the economy would come at the worst case scenario for losing lives. And this is essentially saying that at some point we're going to have to push people back into the labor market, get them off of unemployment, working a job, and this is going to reemerge the spread of the virus. So my feeling is that we're going to be going back and forth from, hey, we're going to run out of money, we got to go back to work, versus we're going to lose too many lives and cripple our entire medical system. And that's really bad for getting the vote come November. If your voting population's dying, obviously that's going to be very negative for trying to win an election. So with that said, I do believe that here's what I think is going to happen in the near future and how it plays out for our portfolio. Okay, so let me zoom out a little bit. Okay, so I believe that much of the world, not all, but much of the world will go into a relatively strict lockdown that lasts into early June. And this is not priced in right now. The rumors, and they've been circulating this every week, is that, we're going to get back to work. Americans want to work. This is flattening the curve. Cases are slowing down. And this is all over. We're going to be fine and rock slingshot back into a healthy economy. But with the data we have and the life cycle of the virus, and you can go to the so-called expert Bill Gates, it's really 10 weeks. Now I've been touting 60 days, but Bill Gates is touting 10 weeks, and he does seem to have a great deal of influence on what's happening. So I think that's the first thing that's being mispriced by this market, is that we're going to be back to normal sometime in late April or early May. In fact, I believe we're going to have to be in a relatively strict shutdown through June. Now, why would we stay in a strict shutdown until some point in June? Well, because the people who have it are most likely going to spread it to their household in the coming weeks, and then go through this 10-week life cycle that allows them to either recover from the virus and create the antibodies, which creates their immunity. At least we believe that to be the case. And then they'll stop spreading it. So we can essentially reset the clock, at least in America, hopefully in more countries, by simply keeping everybody inside and having it a law to wear a mask if you go into any kind of commercial establishment. And that should really give us a lot of time, slow down the spread, and give us time to get a vaccine developed. But also by that time, I believe our deficit will be shocking. The expansion of the money supply will begin to bring questions as to the true value of the dollar. And at the same time, just think of all the liquidations of assets and estates that are going to occur from a sudden shock of deaths to relatively older population. So you got to really think, when someone who's a little bit older passes away, typically those assets are sold off and then split up for the children. They're not necessarily passed and kept in their initial form, which could be stocks and real estate primarily. So by June, I believe we're going to be in a predicament where there's a lot of pressure on markets because of this. We're going to be having extremely negative earnings forecasts from corporations coming out. Stock buybacks and dividend payups quite likely to be reduced. And they're going to slowly but surely have to tell us that, we actually can't open this back up. Otherwise, we're going to start the clock too early in terms of restarting the virus. So I look at it as a fire that we can't put out, we'll never put out. So if you think of the flu, for example, flu's been around for, I guess it really first emerged in the influenza Spanish flu in 1918, which wiped out many people and had multiple waves, different mutations. And again, they have to make a new flu shot every year to try to anticipate mutations. So the overwhelming force here is that we're going to have a growth in deficits, in debt, and a reduction in profits and earnings. And there's really just no way around that. So that's why I do believe we'll soon be back to the lows we recently saw and eventually break through that. Now, I do believe that if we do pull off a lockdown through June and reemerge with masks, we will be able to keep our hospital systems operating. We may be at max capacity, and that there's going to be a feeling of relief and potentially a massive rally going into those summer months. Okay, so that's when I actually think we could potentially enter into our ETF basket that we've been watching, which is healthcare, biotech, medical device, e-commerce, and defense. So my big predictions is that the government's going to have to raise trillions of dollars And a lot of that will be handed over directly to healthcare, biotech, medical device companies. Now, e-commerce is obviously going to thrive because everyone wants to order online and get it delivered. So I do think e-commerce will do relatively better than other sectors. And the next big prediction is that we go on to the offense, probably with a financial blow towards China, and place the blame rightfully on China. So as you guys know, I've been predicting that for quite some time, and now we're getting the political leaders to do the same. So we actually had president yesterday talking about how the WHO blew it. They've been covering this up, protecting China. Now, he hasn't been pointing the finger at China directly yet, and still says he hopes they will make good on their phase one trade deal. My expectation is they do not make good on that phase one trade deal, and that we begin seeing some pretty substantial economic sanctions placed on China and Russia for having crashed the oil market and covering up the spread of the virus. Now, a notable fact is that on January 2nd in Wuhan, the military school for the elites' kids, the communist leaders' kids, went into lockdown, and China went on to throw a free banquet for 40,000 people in Wuhan leading up to their holiday, when they very well knew there was a novel virus spreading as early as December, when they first had symptomatic cases. And so that would ensue that this was beginning back in November. So that set of facts is very hard to deny, and I believe will eventually become a geopolitical tension that will be very beneficial for our strategy. How are we going to take advantage of that? I'm looking at put options on Chinese ETFs. Now, these are ADR products, so easy for the US to absolutely outlaw those products and put them at a zero value. So if that's the case, we get the value of our strike minus the premium. The other big play, and again, this play is for our boot camp fellows. The Hong Kong dollar is at extreme risk currently, and that's a trade that can take $1,000 and multiply it by 10,000%. So that is probably the single best low risk, high return trading opportunity I see over the coming 12 months. And again, that's because the Hong Kong dollar is pegged to the US dollar. The worst case scenario would be it only gets depegged off the dollar to the Chinese currency in terms of our profit opportunity. But the best case scenario would be that they abandon Hong Kong as we revoke its special status, and China moves its stock exchange out of Hong Kong to Shanghai. And that could potentially drop the value of that currency to zero, which would be where we can get the largest possible return on that trade. So that is a very attractive trading opportunity, which we'll cover tomorrow. Tyler, our boot camp module, what is it, Dean, 2 or 3, covers this in great detail. So you do have the boot camp content, right, Tyler? So you can get access to that. Yeah, it's a 2-hour presentation. Even before this mess, Hong Kong was in some serious trouble. And the best model to look at is what happened to Japan. How did they deal with a real estate crisis, essentially, and massive debt? And now how is Hong Kong going to deal with the same thing? So they have something like $300 billion in their currency reserve, but they've issued 1.3 trillion in their funny money, the Hong Kong dollar. So if you did get an event where everybody started to liquidate real estate, which is the most expensive in the world, and also then begin trying to convert their Hong Kong dollars into any other currency, you could essentially bankrupt the currency of Hong Kong. And now China's reserves are now down to 3 trillion. So they are starting to run out of money as well. So I doubt that they're going to cover $1 trillion to protect the Hong Kong dollar if at the same time America is revoking its special privileges. Okay, so that's the big picture. Now, by November of this year, I do believe it will become clear that with our Constitution, we're not able to restrict the spread of the virus, and that we become right back to the same position we are currently, where it begins spreading, begins to become overwhelming the medical system, and we have to go back into another lockdown. So essentially, my prediction is we do a 60-day lockdown from here, open back up the economy with a rule that you can't enter commercial property without a mask, which I believe they can pull off, but that won't be enough, and that socializing will begin spreading this once again, and we have a new wave of problems beginning towards the end of the year. So I think we can see a pretty good crash coming into the next several months, and then a rebound as we reopen the economy with masks, which again, we've seen China do this, and it appears to be working. But again, I think we're going to see China back to having problems as well soon. And then the next big leg down going into 2021, starting around November, December. So that's kind of my 10,000 foot view of price action currently. AJ, yes, it is recorded, and you can go right back to your email to replay it. Okay, so that's sort of the big picture view. Now, some of the analysis that, here's the 40,000 families. This is the article where Wuhan had 40,000 families gather for a government-sponsored potluck. So it's quite clear that they did know what was going on and did not care. Now, whether they're trying to infect the entire world with this or not, I don't know, but the effect of what they've done is indeed causing that. Okay, now some of the analysis that we're looking at to review this. First of all, this is content we released to our boot camp, but there's a really good breakdown of this by a crypto fellow who does interview a lot of people. Shout out to Tom Sharp for bringing these podcasts to my attention. I've always known about him, but hadn't listened to many of his interviews. He has some great guests. And if you did get the Tuesday update, I highly endorse that you do go watch this. Now, for anybody who's not in our paid program yet, you may not have access to our boot camp, but when you do buy any of our advisors, we give this for free for 30 days. In this, he really details how companies have to completely rebuild their business model. We don't know exactly how consumer behavior is going to change. We don't know how long, what exact shutdowns are going to work. We don't know how long it'll take to get a vaccine. And so companies have to go into survival mode, which means not buying back their stocks, not issuing dividends, doing massive layoffs, and cutting all costs to rebuild from scratch a company that can survive in the new paradigm that we're in. So that was about an hour and a half video, extremely well thought out, and highly endorse that you watch that. Peak Prosperity is another resource I highly recommend. He's been on top of this. He's a big gold bug. I do believe that the central banks are going to manipulate gold. They do hold the bulk of all gold in the world and can easily dump it and short it and then buy it back up, scaring weaker hands. So a lot of people just can't stand any volatility. If trade goes against you for a few moments, you're running like a rat on a sinking ship. And so that's my greatest concern with getting overly bullish in gold right now. Really, what has to happen is governments need to raise trillions of dollars, not just here in the US, but worldwide. The central banks can easily team up to make sure that happens. And the way they make sure that happens is by forcing bonds to appreciate, which is an easy trick at the central bank level. They drop rates to zero. They provide repo to hold your treasuries. And then they use quantitative easing to vacuum up the treasuries for a profit. Now, this is, again, is a product primarily purchased by central banks first, then primary dealers second, and then big hedge funds third. And then finally, most money managers have at least some of your assets in these treasury products. So that's where I think you'll see the best return with the least volatility until they've accomplished raising the capital they need. Now, is $2 trillion going to be enough? Probably not. So I do think that number is going to grow over the years. And also, if we can't come up with a vaccine by next year, that does extend our timeline and the depth of just how low this crash could run. Now, I do think at some point, if this does not get resolved by next summer, the Fed will be forced to capitulate and change the legal structure so they can actually buy stocks and put a bottom into the stock market. That's not necessarily bullish for the stock market, but it would be a signal that we need to try to front run that and sell our put options well before. Oil, what's going on with oil? Was the surge in oil production a result of the virus, or was this a planned attack by Russia? Very hard to tell. Russia was quick to shut their border before they had any cases. We know they're an ally of China. So I'm obviously quite skeptical of their actions. In this podcast, Art Berman and Nate Haggins goes through about an hour and a half of great detail on the oil market. And both of them believe we have short-term downside ahead, unfortunately. But in the end, that oil really has to be in the 50 range. Otherwise, all the oil companies go out of business. The next video is from Kyle Bass, which, again, you guys got all yesterday. Good 30-minute overview of the Hong Kong trade. Next, we have an interview from Jim Rogers. And I'm just trying to show you guys how many different perspectives I put into our thought process before making decisions. We're not listening to one source. We're listening to many sources. In this podcast, he does overview why China would move their stock exchange out of Hong Kong into Shanghai, which is critical for predicting the coming moves between US, China, and different trading opportunities. Also, I spend a lot of time looking at science, doctor-related, and virologist-related videos to have a very deep understanding of what we're dealing with. And so that's a good summary of some of the top 7 videos I presented to our members to give you the same insight into these predictions. Okay, so next I'm going to review our trade alert track record, and then go into Q&A. After that, we'll look at charts and top news. Okay, so we have basically two key products we're going to cover today. One's our basic membership, which trades Monday, Wednesday, Friday. Typically, this program only trades US equities. And usually we like to sit there on the SPY ETF and sell covered calls out of the money for income with a downside put to protect us. But as early as February and really late January, I became concerned that we were headed towards a massive stock market crash. So that's how our members were able to sidestep that, get out of the way. We've had some success playing the bond market. We'll take a look at the chart in the bond market. The crash was so rapid, and with the oil market crashing at the same time, we did see central banks forced to liquidate treasuries to cover massive losses that they were having in their equity positions. So we went from a 15% return for about 48 hours in March to seeing everybody sell their treasury stocks, oil, gold, crypto, everything at once. And now we're being fed this narrative that the curve is flattening, that we'll be back to a normal economy soon, and that spending and consuming is going to skyrocket instantly out the gate. Now, if you've ever been a weightlifter or a runner, You know what happens when you take 2 months off. You don't go right back to the level you were at. It takes quite some time to get back to where you had currently been. So I do not expect that we're going to have a sharp recovery. In fact, I think it's going to be a slow drizzle back to where we were at. That could take years to get back to similar economic levels. So in our basic portfolio, we have a two-part strategy. Part one is to own this set of put options. Now, when we first issued these, we were at 240 on the SPY. And by the next Monday in the futures market, we were at as low as 220. And then what happened? The SPY skyrocketed to 272 currently, and has, for people who initially put on these puts, experienced some significant drawdown. Now, I do want to point out that this is something like buying life insurance. You don't want to time your life insurance, and you don't want to trade without it. So we want to own our insurance. And if you're a new trial just coming in, you're going to be able to build this position for about half off of what we initially put into this trade. Now, next week, I do anticipate adding some positions to this with some higher strikes. This again was designed at the 240 SPY level. Initially had gone into immediate profits. And then again, we had this huge injection of capital into the markets. The Fed came up with a loophole to use the Treasury to put $280 billion into LQD, the investment grade bond fund. And those corporations have turned around and bought the market some time by buying back their own stocks. So again, I think this will be short-lived. And my intention is to add to this position and expand upon it next week. So I am going to go ahead and give it through the holiday weekend before we begin that position. So the current set of trades is based on a $75,000 portfolio. If you have $150,000 following our program, you would double that. And for every multiple of $75,000, you continue to double that. So currently we have a set of put options, 619, 220 SPY put, one put option per $75,000. And then we have coverage and downside protection all the way into 2022. Now, we're not long any equity, so we're not actually hedging current positions. In fact, we're using this to generate a profit and to give us the downside protection as we use put option selling to eventually enter into these 5 ETFs. So I'm looking at healthcare, XLV, biotech, IBB, medical devices, IHI, e-commerce, ONLN, aero defense, ITA. So 4 of those will be direct benefactors of the government's deficit spending. And then e-commerce, again, is primarily Amazon and companies like that, who will have a huge boost in revenues and profits as long as they can keep their supply chains operating and keep their staff safe to run their warehouses. So my intention is to, during the summer, after we've had this 60-day lockdown, after all the bad economic data has come out, after all the nasty forecasts have begun, after dividends are cut, share buybacks are cut, after unemployment hits a peak, unfortunately, as most likely the death count has grown tenfold within 30 days and potentially another tenfold in another 30 days. That's when I think we have peak panic and when we're going to have a great opportunity to buy these companies, quite likely half off from where they originally had traded at, if not further lower. Now, again, in case we're wrong, I'm not just going to outright buy these. We're going to actually sell a put that's out of the money for a very juicy yield, which I believe will give us a safe way to profit from these. As the volatility index dies down and we do have hope of reemerging into a economy, that's when we'll flip from selling the puts to owning these assets and most likely let go of all of our of these 3 put options. Now, I do intend to hold on to our 2022 put options beyond this first move down that I'm anticipating, because I think by the end of the year, we'll be back to having to shut down the economy. And at that point, at the new high, I'll also build in a new set of puts that'll be similar to these, but going into 2021. So that's sort of what I believe will happen. At that same time, when these are looking nice and hot, we will protect these with puts. And again, I do try to hold all equity positions for over a year and protect any volatility with puts, so that we can get that less tax burden when we do eventually switch positions. So that's what we have coming for our basic portfolio. Step one today is to own this set of puts. Next week, I may expand upon this. And I would look at this as an investment to give you profit potential for the next 2 years, plus a hedge that's going to allow you to rotate into a very heavy position into these 4 ETFs, or rather 5 ETFs, which again will be big benefactors of the change in consumer behavior coming up, as well as the massive money that the government's going to be handing over to these sectors. Now, I do want to provide a free bonus for trials today. We're also reviewing our pro membership today. So what's going on in our pro membership? Oftentimes I will use an analogy of a house. So I look at our put options as your foundation, the concrete to build your house upon. And that provides our hedge again to eventually build the walls. The walls currently are in cash, but that cash will be converted into equities after we've seen the extent of the lockdown, which again, I believe will not be released until some point in June. So 60-day lockdown, reemerge with masks. This is going to give the world some hope that we can start making some money again and not just survive on unemployment, which again, I believe will run out of cash very quickly and put pressure on the dollar, the bond market. So really we'll have no choice but to push people back into the economy at some point. So these act as our wall. Now, what about the plumbing, the electricity, and the roof? So we look at the TLT, the bond market, as the roof to our house. And currently, per $75,000 invested in our model portfolio, we own 200 shares of the TLT ETF. That's your 30-year Treasury product. And this is where the government intends to eventually push most of this debt. Now, again, if we believe debt is going to grow at an accelerating pace, that's really the key metric to bet up on bonds. Now, is there a risk of inflation? Sure, absolutely. If we're doubling the money supply, you can bet your bridges there will eventually be inflationary pressures. My expectation is central banks will ignore that risk because they have to keep the economy running. So I do expect that the big run up in gold, which is primarily an inflationary hedge, could be delayed, and that the bond market rally must dominate in the foreseeable future. Now, we're not just long the TLT, and we do have a gold position. So why do I have that gold position early? Well, typically, the setup for the banks is to cut rates, which makes bonds go up over time. And then after they force the big banks to hold those bonds for long enough to fix the underlying problem, at that point, they introduce quantitative easing and vacuum up the bonds for a profit. The banks turn around and they get to buy stocks at a huge discount. So it's quite a scheme. It's very unfair for everyone else and really rewards those in control of our banking system. But this time around, the magnitude of the problems at least 10 times greater than the 2008 crisis. That was 300 billion in mortgages that were defaulting at a high level, I think around 20 to 30%, that were turned into derivatives, probably a 3 trillion relative value. So what was the cost to the government to paper over that? Well, during Obama's run, we grew the deficit from almost nothing to $4.5 trillion. So that's how you can easily calculate what it costs Americans to paper up the banker's mistake, loaning out mortgages to people who couldn't afford their house. This destruction is not localized in America, it's globalized, and it is far greater. That's why I think the downside risks have to be greater than the crash we saw in 2008 and the dot-com bubble. So I think the expectation to pick up stocks at a 50% crash will trick many investors exactly around the summer point, that we get a big rally that then turns into a new leg down into 2021. So I do expect that we can blow past 50% drawdown and go from there. To find out if we can really get a vaccine and really cure the underlying problem. So that's why we have a small position in GDX. That's gold miners. I love the fundamentals of that. We might see central banks sit there and punish spot gold every time it gets too hot. But then I believe we'll see them buy it right back up as it hits a new low, because they do want to control that asset. What they don't control necessarily are the gold miners. And so as long as the gold miners are allowed to work, which they may not, I do love their business model. Cheap oil, expensive gold, devaluation of fiat currencies worldwide. I love that position and do intend to put more and more exposure into it over the course of time. And by the course of time, I'm talking about every 120 days is when I'll look at increasing that. So right now we have about 40% of our total assets in the bond market, 10% in gold miners. But the real risk is nowhere near that level. Why? Well, we use the married put strategy. So every week on the TLT, because again, I believe the TLT is going to be our best money maker for the next 12 months. Then we want to buy a cheap out of the money put and trail the TLT to the top. Now my short-term target is about 175 to 180 before I do want to tighten up that put option and predict that we might have a pullback in the TLT. And that's where exactly where we got on this first leg down before central banks began taking profits on treasuries to cover all the losses they had in the rest of their portfolio and to really stop the carnage. So they sold treasuries, probably bought stocks to help slow down the crash. And that's really the big move we saw in the TLT recently. It popped up to 180, crashed down to 139. Now we're back to 165 on the TLT. So it's been a wild ride. We haven't changed our outlook for a split second this year. And it has required they have a good understanding of the fundamentals to ignore the noise. Okay, so we use the married put. We want the put option to go to 0. We want the TLT to go up greater than the cost of our put option each week. So tomorrow we will sell this put and buy a new one expiring next Friday and continue to do that until we get towards that 180 level. As we approach the 180 level, look for the put option to go from out of the money to quite likely in the money, which will provide great protection on the TLT, allow you to hold that position without selling it so that you can hold it for over a year to get the lower tax rate. So that is our goal with the TLT. GDX, we have the same strategy, but we're buying longer term protection with the married put strategy. So we currently have downside protection until May 15th and expect me to potentially add an additional put option on GDX next week. At the same time, I'm adding put options on the SPY. I do believe, unfortunately, that right now gold and stocks are still highly correlated and that we'll see both of these sell off at the same time. So again, I do want to hold GDX for over a year for the lower tax rate, and we can adequately protect it with the married put strategy. Now, at some point, we'll let go of our puts if there is drawdown and hold on to our GDX position. The call option we currently have open for anybody who's a new member to enter on the TLT is the 170 January 15, 2021 TLT call. So that's the only TLT call option I currently endorse. We've had quite a few already open, but now the other 3 are in the money. So we don't want to have new members taking on greater risk than we initially did, which was carefully calculated to be small. Potentially this Thursday or next Tuesday, I do intend to add some new TLT call options to our portfolio going into July and future months. So you can expect that. I'll probably hold off on it tomorrow, but we'll just have to wait and see. We'll see the analysis tomorrow where we spend the bulk of our time on the TLT. The change today for pro members was we let go of our 2 GLD call options, which were expiring 4/9 and 4/17. So I do intend to catch a dip in gold, and instead of buying these short-term call options, look at longer-term leap options. As again, I do expect the bond market's going to hog all resources. Central banks will punish early gold investors and force capital into bonds and equities is my expectation. We do have a long put option that's really deep in the money on emerging markets, and that's still a hold, but I don't endorse buying that today. And again, I'm looking at a FXI put option next week, early next week. How's our returns so far? We have some drawdown in the portfolio, and this is primarily from our put options losing value on the SPY, and we've had a little bit of a pullback on the TLT. So we are showing some drawdown, far less than the S&P 500. And again, this is actually right here, the return in our basic portfolio, not the pro portfolio. So we're having a little drawdown due to this magnificent rally in stocks. But again, I have not changed my outlook. And it's not the first time we've had to sit through some drawdown. Okay, let's go ahead and go into Q&A. And then we'll look at charts as well as news. Okay, Jack 10 says we have a call option. Should we sell it? No, we did not issue a sell alert on any TLT positions today. Okay, Jeff says when they go to CNBC, they try to manipulate everyone to buy stocks. Yes, they absolutely do. That's what they're paid to do. And if you read their disclaimer, you can see who funds these different media agencies.
Hey, Jason, you can't see the chat box anymore when you move it on the screen. It's just like a black box, so might just want to move that out of the way.
Okay, thanks, Ryan.
Zoom's doing some security stuff on us.
Yeah,
Oh,
and the hot links no longer work to you guys, so I'm sorry about that. I sent a bunch of trials link to book a coaching call. Just copy and paste that link into your browser. Sorry about that, guys. They changed that on us out of nowhere. And Jason, looks like Pat has his hand raised.
okay, great. Okay, so I do see a question. The other side of the vaccine is test people, make sure they had it, and those people are back to work. So testing and trace test. Yeah, good point, Pat. So, but again, good. So that's a great point. Another thing that would change my outlook was if I thought maybe 10, 20, 30% of the population already had the virus. Maybe it's been spreading for years. But you can just look at Albuquerque, a completely random city. We have 500,000 population. We've tested 17,000 people, and we have 500 infected. So that's a pretty good statistic. That now that doesn't test for the antibodies, so that's still something that could surprise us. But I believe we'd have a lot of dead elderly people in Albuquerque if there was anywhere near a higher percentage of people who've had the disease, unfortunately. So I'd be shocked if more than 1 out of 100 Americans have it. So if you think of it from that point of view, think of this as a hour 40-minute video. We've watched 1 minute of it. That's how much of the population's actually been exposed to this. Karen says the New Yorkers and Brazilians showed up. I saw that video. They're standing too close to Miami. Yeah. So we're still not, I think we've accomplished slowing down the spread with all the quasi lockdowns. But it does raise a lot of constitutional questions. So they're having a hard time forcing everyone to stay put. I guess they have drones flying around New York now, telling people to go inside. Okay, let's see what I'm going up to the top and I'll come back down. Okay, Jim Willis says that on the Hopkins site, you'll see a downtrend. Okay, well, let's look at the trend here, guys. So we're not able to test everybody fast enough. Okay, so that's one. So the best what can we test accurately? We can test all the people passing away, at least in the hospitals. So this is your best leading indicator, unfortunately, is the death count. So again, I believe we can flatline this and get it to drop down by June, at least late June, by putting on a full-scale lockdown and then reemerging with masks. Unfortunately, I do not believe that will be enough. And by this Christmas, we see the second wave developing. So I do expect a significant sell-off in the coming months with a rebound going into summer, and then the next big crash coming sometime towards November, December as this reemerges. Jeff says SPY is rocking. So shout out to, who is it? Steve Lane called 270 rebound. And we had another member predict 290. I'll be shocked if we hit 290. Jeffrey Gunlack predicted that we'd hit 270 rebound and then crash from there, which is one investor I highly respect. But it's a guessing game when the Fed's going to come in there and save the market. Technicians, we're looking at every technical level all the way down, and could have easily predicted at any wave level a bounce and a retracement. So when I put that trade on, it did look like they were going to let it crash far further. And we went limit down right after we placed that trade, but then they came in with this rescue package. So that really points out the key to, Bill says, what are we gonna do with the TLT married put? We're gonna roll it over tomorrow. Pat says he thinks China's the best indicator. So yeah, we'll see if they really can keep but we can't trust anything out of China. So I would definitely, okay. Steve's saying we're going to hit 278, 290 by Monday to Wednesday next week. Oh, and okay. In the ES. So, okay, so that's a great point. We're going to talk about risk management. That's why we didn't go 100% into these puts. And now we have plenty of cash on the sideline to double down. So I would love for it to go even higher. That means we make more money on our puts. Let's see, Pat, go ahead.
Yeah, I just wanted to say there's a couple of guys that I follow on Twitter that are Chinese, not Chinese Communist Party. They're very critical of the party, but they translate Chinese information all the time. And they're clearly saying that they're not back to work. Yeah. That's what I was trying to get through in my text. I'm sure I didn't text it well enough, but
another good indicator is to look at the pollution China's putting out. So until they're back to stinking up the world, we can tell they're not completely back to work. Okay, so Steve says evil scenarios, suck in the lungs and pull the rug. Yeah, I believe that's right.
That's Wall Street's game.
Jim Wills says, with the high SPY rising, should we raise the strike price? Yes, the new set of puts will take into account a higher set of strikes. So I'm okay with leaving this set open. But yeah, I would anticipate the next set will have slightly higher strikes. So great point, Jim. And yeah, I've just continued to delay pulling the trigger on that. But my fear is that in no less than 30 days, the death count will be at 1 million. And this could happen as soon as 15 to 21 days. So I think in the next 2 to 3 weeks, that should do the trick to get the next leg down beginning. And then I think the way we break through the most recent low will be when we don't get back to work in May, and this drags on to June. So I do anticipate that we'll have to raise those strikes a little bit on the double down set of trades to add some more immediate benefits, because the current set are very far out of the money currently. MHOG says, we'll break 52 week. I have to exit my trades as I've been failing since inception. All right. Any other questions out there? I do want to look at some charts and news next, so go ahead and keep posting your questions if you have them. Okay, so let's look at some charts. Here is our favorite comparison, the stock market and the bond market. These two are always battling for control. And the real giveaway here can be best illustrated right here. So we have this massive rally. So the stock market had a change of price from being -25 to 7.5. Okay, so we lost in the SPY, we saw a bounce of something like 22%. Now, normally in a real recovery, what we would see is probably about half the move over here. So if we saw a 22% recovery in stocks, you would anticipate about a 10% drop in the TLT, but we went from 36 to 33. So the bond market did not budge. That should give away that this is not anything but market manipulation. Furthermore, again, the outcome of the TLT is really regardless of how much the powers that be manipulate stocks. Now, stock market has some limitations to how long they can manipulate it, okay? Because it's valued at something like $25 trillion, and our current balance sheet of the money supply has jumped up to $5.5 trillion. So if we put every penny that's ever been printed directly into stocks, you could only buy up 20% of its assets. So they can easily handle something like $100 billion a day of liquidations. But if you get towards $200, $300, $400, $500 billion of daily liquidations, that's when they lose control of the markets. And so unfortunately, when you have so much downward pressure, you have people unemployed who are going to have to liquidate assets. You have people passing away who are going to liquidate entire estates. You have CEOs who know their companies are totally screwed, who are just going to sell while they do stock buybacks, as they know this is the last chance until they see what happens here. And at the same time, you're going to have all the money being forced into bonds where it's going to be easy, guaranteed profits. So stocks, we want to see revenues and profit growth. The chances of that happening in the next 12 months are really slim to none. And we're currently at a PE multiple of 19. So that was, I believe, the high of 2017. So we're still at very frothy valuations. Go ahead, Bill. Bill's got his hand raised.
Yeah, I'm just, excuse me, I'm just wondering that, you know, if the earnings reports, et cetera, are going to, you know, bring people to reality, that's not going to happen for another month, right? You know, we'll have unemployment numbers, but everybody expects them to be horrible. And theoretically, you know, the market's already priced in what they expect. So, and of course, you know, Wall Street and our government is saying, oh, we're going to have a V-shaped recovery. So what makes you think that within a month we're going to, you know, that the market's going to crash?
So earnings start picking up about 2 weeks from now. On the 22nd, you start to have some of the biggest companies report, and really it's the second to last week of the month, and then the week after that is probably this earning reporting time.
Yeah, so well, let's look at the big picture. We don't want to miss a once in a lifetime trading opportunity. Okay, so you don't get crashes of this magnitude very often. So here's the last two crashes. They happen quite quickly, and there's plenty of little rebounds and bounces. So the big picture is, I believe we're going to have a crash greater than this magnitude, and then it's likely going to last 2 years, not 1 year. So from that perspective, I'm not trying to time it perfectly. I don't want to miss out. So yeah, this could linger on longer, but I also believe that unfortunately in 30 days, this death count will be 10 times larger. In fact, it could be 10 times larger in less than 30 days at the current growth rate. So yeah, you just have what do you have going for you? You have a little bit of funny money from corporate buybacks that the Fed injected. You've got a few central banks trying to protect it. And then you got everyone else trying to get out of Dodge. So yeah, I would be shocked if this rally lasts for much longer. So I think we're going to be very happy with our trades. So next week I do intend to look at adding to our puts.
Okay, thanks.
Yeah, but good point. Could this go on longer than anticipated? Sure. But again, we have 2 years of downside put options with a relatively low percentage of our portfolio when you calculate that this is covering us for 24 months.
But the weekly puts, they're costing about 1% a week, right?
On the TLT?
Yeah.
That one did, but I do intend to try to reduce that cost as soon as we get the momentum moving in our favor. So we're at 165, and I'm looking for us to catch a move up to 175. So I'll get more and more cheap with those puts. My concern was that we saw this rebound forming, and so I did want to have a relatively more expensive put this week.
And there's no rationale to, buying a new put, a day or two before that, you buy or you sell the other one, or you sell your existing put a day or two earlier in order to get some premium out of it, instead of letting it expire worthless?
Yeah, so we'll sell this tomorrow and buy a new one tomorrow at the same time.
Okay, but there won't be any value to it tomorrow, right?
Well, it depends on where the TLT is at. But yeah.
Yeah, okay, I hear you.
That's our insurance. So really the out of the money put that we're holding, if I thought we had greater risk in the TLT, I can adjust the duration so that we had 2 weeks of time premium and then rotate that halfway in. So that's a change we can do. But right now, my expectation is very soon we're going to see the SPY weaken and the TLT strengthen. So I think we can get away with a cheap put with the least duration and just hover it. And so this will only provide value if it goes into the money. So very good point, and you're dead on.
All right, thank you.
Very good question. Scotty has a great question. Why is IWM, the Russell 2000, which is your small and medium-sized companies, rebounding stronger than the SPY? I expected them to get really hit. Yeah, many of those companies can go completely bankrupt. So it just goes to show you that the market's being highly manipulated right now. Jim says, what about other inverse ETFs? Yeah, right now we have the tech sector and the banking sector. So those are currently our only buy and hold recommendations for the buy and hold strategy, which I think will do the job quite well. Yes, Scotty. So yeah, small business, the big impact of this is that large corporations are going to have a huge unfair advantage and be able to gobble up all their competition. And this is from the banks, corporations. So yeah, that's surely just pure and utter manipulation. Kevin Patel says, do you think plasma transfer from recovered patients could be helpful form of treatment? I don't think it's scalable. So that'll probably be something the super rich have their hands on, but not your average Joe. Pat, go ahead.
Yeah, I was thinking about this the other day. Most of the pension funds in America are going to crash.
Yeah.
And I didn't know if there's a fund that you could look at and start to go down that path, because I really think people aren't paying attention to that. It's kind of like a side thing that's going to happen.
Did you see the note that all the pension funds have put out?
No, I didn't see it, but I'm sure it's crazy. What's it say?
They're going to stop rebalancing, which means they're going to stop buying stocks and selling treasuries.
Wow.
So that's good news for really the TLT has the perfect setup.
Yeah.
Now Karen sent me an email. Jim Rickards, who I love to listen to, sold his TLT position yesterday. Karen, how's it going?
Hey, it's going, but boy, there's a lot of interesting ideas out there. And yes, I am very much paying attention to the whole pension concept. That's one of the first things I cued in on. So I'm curious to hear your comment. So please.
Oh, well, yeah, I mean, we're in a mess. I honestly, I know I track what their behavior is in terms of buying and selling. So that's the big news that's come out for the pensions, is that they're going to ride the Treasury position and not rebalance, which means they're going to let their equities just stay put. And then, so yeah, all the big money knows what's going to happen. The big banks don't lose money. So they're going to be buying all this debt, and the Fed's going to buy it up for a profit with QE. So that's what I really like about the bond market, is it's not really, we don't really need anything to happen except for what they've already announced they're going to do. So they need to go sell 2.2 trillion for the current stimulus. And then they're going to come out with an infrastructure project for another 2 trillion. So until all that money's been raised and the investors have been paid a handsome return, this is by far my most lucrative trading opportunity when we're looking at high return with low volatility and extremely little risk. So if you talk about follow the money, well, globally, it's going to all go to governments so they can try to patch up all the holes in their economies. Now, we all know what Jim Rickards likes, and that is gold. He thinks that there's going to one day be a switch flipped, and we go back to a gold standard, and gold's going to go to 10,000. He's got a handful of cryptocurrencies he likes. Great historian. I love to listen to him. Interesting that he had his bond. I'm sure he's concerned about the quantity of debt and the credibility of the Fed and the risk of the dollar. So what would make me become fearful of what he's fearful of? Here's your key indicator. If the dollar index weakens significantly, that's extremely bullish for stocks, bad for bonds, and would mean that global economies are recovering and able to keep up their debt payments and have plenty of dollars to operate. And so I do think that's the goal of if we have been attacked, I think the end game is to devalue the dollar so that other currencies can emerge.
Can I give you a couple comments of things I've heard recently and see, what you think about it?
Sure.
Okay, I heard it was yesterday, maybe it was the day before now. Just some of my other sources that I listen to occasionally that have access to some hedge fund guys who, they do what they do. But when they start talking on a pretty high level, and then I'm getting a text message from a friend who's involved in it and says that some of these very high end, in London, New York, Hong Kong, all this stuff, that they're trading all this stuff all over the globe, and they're starting to question the credibility of the federal government. I mean, they flat out said it on the call, and that was a little disturbing. Of course, they could have just been saying that, but that apparently was highly unusual that they said that. So that was one thing I heard. The other thing I heard, I personally spoke to the guy that I have purchased physical gold from in the past, and I asked him a little bit about what's going on in his world. And he said the physical gold has not really budged. If anything, he's had huge demand over the last several weeks. And this is a group that's been in business for over 40 years. And but I asked him about gold miners as an example in the future because of what we're doing. And he said right now they can't go to work.
Yeah.
So just like what you were just talking about. So I thought was interesting.
I'm dying to put on a huge gold miner position, but I realize that they may not be allowed to go to work. I know the silver miners are shut down in Mexico.
Right.
And I know the central bank, it doesn't. So what would happen if we don't fund the 2.2 trillion stimulus plan? Well, then the bond market crashes because the growth of debt is going to deaccelerate, and the stock market's going to crash. That would be devastating. So I think that the Fed will sit there and print its little heart out and ensure that the bonds are sold and that the buyers make money. And they have complete control over that. That's the one asset that everyone expects them to manipulate. So we can go back to that circle of life for the bonds, but the game plan is you make it free for the primary dealer to borrow, and then they buy a treasury with a positive yield, put the treasury into repo so they can go reloan the money out so they're not clogging up their balance sheet, which also provides some stability to stocks. And then after the problem's resolved, the Fed brings in QE so that these banks who've made the investment and the risk can get paid off a nice payday. Now, this time around, they're doing QE at the same time. So that makes the TLT even more attractive. But yeah, the big risk here at the end of all this would be losing the dominance of the dollar.
Right. And then the other thing he talked about, just to throw this in the mix for you, is the big adjustment has been in platinum recently. It's gone down considerably compared to palladium and rhodium or whatever. But that's those guys are in a whole nother world. So that's why. But I wanted to throw that out because that has changed quite a bit. So he's actually done adjustments on a lot of clients' physical portfolios. Like some of the silver did not, eventually he does still believe it'll go back too, but it's going to take a lot of time. But they're using platinum, but he can't find it anymore. Not in a coin. He's got
the chart on platinum and all those metals is just so insane. Yeah,
exactly.
Interesting.
So, yeah, that. And then I think the last comment was, was that whole thing about the rebalancing twice in 2 weeks, on the 10 minutes to 4. All of a sudden, the $7 billion and the $2.5 billion dump into the market at the last 10 minutes before the end of the close of the market. I mean, that just happened yesterday again too. So it's very confusing. So that's why
this is the cue for all the rich to get out while they can, because what comes next is horrific.
Yeah, and interestingly, look at all these. And I just heard earlier, I guess the Senate's looking to pass more money through that by maybe tomorrow. So that could influence some stuff before the 3-day weekend. I mean, this stuff is so volatile right now. I saw a gun-like old chart, actually. I want to see if I can copy it. You might have seen it on a text that he had a few days ago. It's very interesting. It shows that there's like a type of recovery like we could be in now, and then another smash going down. I'll have to see if I can find it and send it to you. It was interesting to look at. So,
Okay, great.
yeah. Okay. Thanks for keeping what you're doing, because
I know it's tough to see trades go against us, guys, but I'm extremely
I'm just
confident.
hanging in there. I got my claws out a little bit.
A lot of people are gonna buy this right here.
Nope.
Next
Bear trap.
week, and then boom.
Yeah.
Bad.
Thank you.
Interesting too, guys. I've been watching the put to call ratios all week, and they just literally just keep getting bigger and bigger to the put side, and lower in the strikes too. So that's been interesting on SPY and SPX.
Yeah, that's why I want to find that chart, because it's absolutely in line with what that chart does, and it's unbelievable. Exactly what you're saying, Dean. It's perfect. So
yeah, I just saw that today. I'm like, geez, this is just nuts. And
oh yeah, the option market is so screwed up. These are all supposed to be positive, and they're negative.
Well, and of course the premiums are all off because of it too. It's bizarre. What did I read in that article? 32% off on the premiums.
Yeah.
It's crazy. Yeah.
And you have no downside protection in option writing. There's some at 250. It's too expensive to insure your long position right now. And that's gotten cheaper. They've crashed the VIX from 70 to 40. So people are loading up on those puts who know what's going on.
Wow.
Let's see. I did see that Kathy had her hand raised too, right?
I did.
Hey, Kathy, how's it going?
It's going good. Just
excellent.
I just don't look at the value of that SPY right now. But I do have a question. So you sold both of your gold positions. I understand the 409 expiration, but what are you expecting with gold that you decided to sell the one that ends next week?
You know what? I've come to find that the more simplistic I keep the portfolio and the holdings, the better results our audience gets. So those were kind of just oddball. I think you could potentially get a little more out of it next week, but in our portfolio, I did close those out so that we just have the very simple holdings. So it's now so simple, it's very hard to make any mistakes. We have 200 shares of TLT, 400 shares of GDX, giving us gold exposure, which is highly correlated to gold. And actually, in a little bit, I do want to go through a timeline of the 2008-2009 crash and look at, how is gold miners, silver, and the SPY behaving, and which had the best relative returns during these different periods.
Your alerts are so clear now. It's really helpful. Thank you.
Oh, good. Yeah, we definitely needed to make it easier to understand. So I'm glad to hear that feedback. Pat, go ahead.
Yeah, I just wanted to bring this up. I kind of touched on this the other day. The thing that I've been doing some research on is that petroleum is around the world, except for Iran and Russia and maybe China. That's why they're kind of our enemies. Is traded on the petrodollar. And so guess what I'm nervous about, and it might even just help us, but Trump is threatening to do as I mentioned the other day, to actually put the actual tariff on oil to protect the jobs here. But that could actually, first of all, that would probably take everybody off the dollar. Like the US dollar is pretty much the world's currency, and people kind of flocks to it, and they flock to the T-bill. But if people aren't trading because there's a tariff and you've pissed off Saudi Arabia and who else, even just Saudi Arabia, if you just look at the trillions of dollars of trillions of barrels that they trade every year, that alone, just times that by the number of T-bills they need in order to trade it, that alone will either crash the economy or it will really screw up the way the T-bill is traded around the world. So it's just, and I'm not saying I know how it's going to come out, but I know it's a problem to be aware of. And
Sure. No, yeah.
Yeah.
So those daily press conferences are so valuable right now. So just everybody knows it. Around 5:30 Eastern, there's a daily conference, and I think it's
Yeah,
7 days a week.
yeah,
So far, his commentary has not been putting on tariffs or bailing out the oil companies necessarily. He has mentioned that they've had a meeting.
yeah.
Has considered that they could put tariffs, that he loves tariffs. But really his overwhelming message has been that he thinks the market will fix itself. So I think we're going to fill up our reserves, which won't take long. And yeah, did you watch the Art Berman? Let me show you which one you should definitely check out if you want.
Okay.
This
Yeah.
one's really good on the, this is a killer 1-hour interview all about oil. And bottom line is, yeah, it has to rebound. It has to be protected as a national security.
Yep.
But does that really change our outlook on economic output? No. And does it change that the deficits are going to accelerate growth? No. So from that standpoint, it does not have me adjust our TLT position. No, that's not it. This one
So,
is.
yeah. So tomorrow's a big day. If there's no trade deal tomorrow on oil, you're going to see the crash tomorrow.
Yeah, it's when the big players decide to sweep the rug from us, I believe, is when we're going to see the next big leg down.
Yeah.
Now I would love for this to rally into next week, much higher. Let's look at Steve's new point, and that's why I didn't bet the whole farm initially. So we have a lot of dry powder, and we can buy some more puts next week. And remember, if the higher it goes, the greater of a potential drop and a greater spike in the volatility. So that's actually really good for us. And more time to position ourselves in the TLT. Oh, thanks for joining us, Pat. You always have great commentary. But I did post that link. Now, the bootcamp content, guys, is always spectacular. Realize I'm probably watching 100 to 200 different videos a week and then pulling out the most useful 5 to 7 for you in the bootcamp. And each of these videos are typically 1 hour to 2 hours. So you got a lot of really good information to study every Tuesday. Okay, let me get through some more charts and I'll keep a lookout for. Oh, Tony, how's it going, Tony?
Well, I could be better. Could be better.
He doesn't like that drawdown. I don't blame you.
Hey, yeah, that's what I was looking at on the SPY position. I didn't get all in at once, but kind of tranched in. It looks like our puts are down about, just a shade over 50%. But in the allocation of the $75,000 per category there, that makes our drawdown about 11% or so, or 12% in that area. So in going forward in next week, would your reasoning behind adding to those put positions be to average down if it does rally up? Or what?
So let's see. So my base cost was less than that. My base cost was under 10%. So about 5% drawdown.
Okay. Yeah, I had probably a little bigger cost than that. I'd have to look at your portfolio thing and see how it compares to mine.
Okay, yeah, definitely check that out.
Yeah, but I was just curious. Right now, being down 11%, it's starting to pull the whistle along. Hey, what's going on here? How far are we going to go? We're going to average back out if it goes against us so much further.
So yeah, the grand scheme of things, these puts are looking for somewhere around 500 to 5,000% return. So in the grand scheme of things, and with the duration we have and the disaster unfolding, I'm not concerned. But yeah, I'm having less drawdown than that. So I'd definitely be interested in seeing what exactly you got going on there.
other thing that I came across there is the way it's reflected on the spreadsheet, but I don't want to get into that over talking about what you allocate rather than you invest. So I don't know if that makes sense to you, but I'll do a little more research on that and get with Jason on it, or with Dean, and see if I'm doing this right.
No, send it to me. I'm your go-to guy for any trading questions. Okay, so Dean will help you figure out which package you want, but I'm your man. So just email and support what you came in on, and I can review that. Make sure you're good to go.
Okay, and well, I'm just tranching in, like I say. So we're up to about 6 tranches now, and that's about where I am with the investment in the puts. So with that, with today.
So yeah, remember guys, we have till 2021 for the majority of this and into 2022. So we got a lot of time for these to pay off. And we're going for gains that are in the 500 to 5,000% return. So highly leveraged trades with lots of time in front of a once in a century crisis. So this is a once in a lifetime opportunity to short the stock market here.
Well, that's all. I was just curious, if your intention was to average down a little bit, but so you're saying of course you got in on the first signal, and I did too, but I didn't get completely in.
Yeah, let me know what you paid for your positions relative to each 75,000 lot, and I'll take a look at that.
Okay, bud.
Yeah,
Okay.
excellent too, Tony. That was really helpful. And Jason, a couple people are asking about the Hong Kong bonus trade.
Yeah, so we're gonna my alert to you guys yesterday was to get $1,500 into your Forex account per 75,000, but do not place the trade yet. Just get approved and get it in there. Thursday, I am going to review how to place the trade and the profit opportunity, but not pulling the trigger just yet. So I want to see a little more geopolitical tension develop between US, China. So I'd say within the next 60 days, we'll place that trade. But the trigger will be to see, and we're seeing it. We're seeing Trump slowly but surely point the finger, not flip the finger, but point the finger at China for this mess and the WHO, which is curiously funded by Bill Gates. So there's a lot of big questions that can't clearly be understood right now. Go ahead, Karen.
Yeah, power play. Yeah, I was asking Dean because I was going through the old boot camp videos, and I was just trying to get to some of the real meat of it to get myself positioned correctly. Because you were doing he wanted me to ask it live, so I am. So I think you were doing with the Hong Kong trade was more leaning towards doing it on TD. And then the other one, the futures, was more on the IB. So I guess I got myself confused on what in the world I should do in order to make it do the best thing I probably can do. And you were leaning more towards doing it using the Forex versus the futures. Is that right? So that would be more leaning towards TD. I know Dean went IB. So I'm trying to figure out what I'm supposed to do.
Yeah, I don't see the interactive broker trade happening because our anticipation was that America was strong, China was weak, and that China was going to keep getting bullied by the United States with tariffs, which is their reaction to tariffs is to weaken their currency to offset the cost of tariffs. But now the US is weakening the dollar by printing trillions of dollars, and they're lowering interest rates. So that's the exact opposite of what we'd want for that trade. The reason why I like the Hong Kong trade is we have almost no risk to the downside, practically zero risk that we lose money beyond the swap cost, which is like 2% a year.
Okay, so when I go to because I don't have a TD account at this point, so when I go to do that, am I, you said, move your money over to there. I just don't want to do this incorrectly. I want to expedite this. Am I telling them I'm doing Forex, or am I, because, I don't have a history there. I just got you guys as trainers. Or do I go ahead and just get the account open in options and then request to move it over? I mean, I'm just trying to expedite this. If you guys have any expertise in how that works. So I don't mess up.
You'll have to set up a general account and then
Okay.
apply for options and Forex at the same time. Well, you don't
I
even have
gotcha.
to. You don't have to apply for options, but apply for the Forex.
Okay. Well, I may just do both, just so I'm positioned accordingly. So, because I've been doing everything in an IRA, and I'm going to keep it where it is at this point. But yeah, that was another Dean question, but it was actually the tax question, but that's another thing for another day.
Okay. You understand it's better to be at TD for that now too. So thank you.
Okay. Okay. All right.
What's
all
the
right,
symbol
very
for
good.
that?
I beg your pardon, Brian? Who was that?
This is Tony. I just what the symbol is.
HKD.
HKD.
So this puppy's been flat for decades because it's. Whoops. Let me.
Yeah, it's been pinned.
It's designed to be a peg to the dollar. And so the bet here is that right now Hong Kong was sold to China, but they're supposed to have a certain set of rules that are more like a democracy and a free market, unlike China. So China's been using Hong Kong as a financial center to raise capital, and it's created outrageous real estate prices in Hong Kong. And that's really the big picture, is that the US could easily put financial pressure against Hong Kong by revoking its special status, which would destruct its ability to raise capital. And so the good outcome would be China depegs the Hong Kong dollar from the US dollar to the yuan, which I believe would give us a several 100% return at a minimum. But if they just decide to abandon Hong Kong because they couldn't afford to cover basically $1 trillion outstanding on the currency, at the same time real estate could crash, then they may just completely abandon the currency. And so Kyle Bass has a really good thing. The peg of an economy should be related to its closest trading partner, which in this case is China. But instead, they've pegged it to the US economy. And so there's quite a big difference there. And that's what's causing the stress on Hong Kong. So if they completely abandoned it, then we get to the potential 10,000% return.
I completely agree with your analysis of this, because even before you started talking about this, I was aware of, or maybe at the very beginning of it, I was aware of these extremely wealthy long-term families from that area that had absolutely moved everything out of that area of the country, and they've moved to various places and in the world, and they've left Hong Kong for good. It's extremely sad, after the transition over from British rule. Yeah, it's just you're absolutely right.
So Jason, why would they just abandon the peg versus just repeg to China? That would seem like the most logical thing to do, and it's almost a one-for-one currency relative to US dollar, right? It's about 7-to-1 roughly.
Correct, 7-to-1 right now. So the risk would be that there's the real estate here. I'll pull up I'll cover this more on Thursday, but the bottom line is the real estate's at 10,000 a square foot. China's already slowly but surely trying to move their market out of Hong Kong into Shanghai. And there's $1 trillion outstanding to cover. So if everybody tried to convert out of the Hong Kong dollar and started selling real estate at the same time, it could be a huge liability for China. And China's reserves are down to 3 trillion currently. So that would eat up a third of their reserves if everybody tried to liquidate at once. So that's really the risk is almost nothing to the downside, and the potential upside is either a depegging to the Chinese currency at some sort of conversion rate, or they abandon Hong Kong altogether. And if Hong Kong lost its special status, then that's what would lead them to potentially abandon Hong Kong in some shape or form. And so there's other pegs in history that have been completely abandoned in the past. That's why Kyle Bass is so attracted to this trade. It's the low risk, you pay the swap cost, and then if really hell breaks loose, which is what would happen, then there's a huge opportunity there. So for me to place that trade, there's very little risk, but it's quite an outcome for that to begin. So I think we have to see China fail to make its phase one purchases. Now that could throw another hiccup. Imagine China obviously did this all on purpose, but they start making good on their phase one deal. That's going to make it very hard for us to put political pressure back on China. So that's really the long and skinny of that trading opportunity.
Good to look at both sides, but you know how I feel about that one.
Yeah, they may just want to try to taunt America by not. So far, I don't believe they're getting anywhere near, which you could excuse with the current predict. And we've seen Trump talk about that. He's been saying, well, they're making a few purchases here and there, but they're not quite living up to the bargain yet. So yeah, if we think there's tariffs coming, then the trade against the yuan is more attractive with interactive brokers through the futures market. If we think that there are a pretty severe financial attack on China at their markets, then I think Hong Kong's a pretty easy target. And then the Hong Kong trade becomes attractive. And so phase two, we all know, is really out of question for China. That would completely declaw the cat or clip the wings. So probably in the scheme, I've become less attracted to, when we first started planning for the devaluation of the Chinese currency, we weren't predicting that in the first quarter of 2020, we would cut rates to zero and begin QE. In fact, I thought that was going to happen in 2021 after the election, and that we'd have a relatively calmer geopolitical environment. And so definitely what happened caught everyone off by surprise. So I do anticipate that we potentially start creating financial sanctions to retaliate against China. And I'm not thinking it will necessarily be tariffs, but rather choking off different companies and potentially Hong Kong from capital instead of tariffs. Mike from New York City has his hand raised.
Hey, Mike, go ahead. We can, we got you unmuted there. You're good to go.
I think that was by mistake. Sorry, I didn't mean to unmute.
No worries.
Okay, let me get through some charts and news, and then I'll come back to questions. Okay, guys? Because I do have some good stuff. Mark says China would sacrifice 1 million plus people and wouldn't lose a day's sleep. Yeah. Tyler says, so yeah, Tyler, you actually do have to transfer the funds to the Forex account specifically. And so with 1,500, we're going to place 1 mini and then have $500 of breathing room in case something totally unexpected would happen that would make the trade go against us, which wouldn't make any sense at all because it's designed to track the dollar. So the downside risk should be really the swap cost, and the upside potential is either depegging it against the dollar to the yuan, or just simply a complete collapse of that currency, which would really only happen, I believe, if we revoked its special status, making it not useful for China to raise capital. And then they'd move their market to Shanghai, which Jim Rogers predicts will happen regardless of us revoking their special status, by the way. And he's a big old China buddy. Okay, so let's look at some charts. So this was what we were predicting, is that these two would cross. They crossed. Now I'm expecting that they will blow past one another. SPY lower, bond market higher. So we all know that relationship. It's very difficult for these both to go up at the same time. And right now, I believe we're going to have a lot more money flowing into bonds and a lot less flowing into stocks, because stocks are likely to have less profits, less earnings for the foreseeable future. They're going to have to totally redo their whole business model, cut costs, let go of unuseful employees, create products that work in this environment, get rid of products that don't. So it's going to be some big changes that are not completely calculated yet. We just don't know how bad it's going to get or how long this will last. What we can count on is the government's going to raise the capital for the bills they've issued. So far, it's 2.2 trillion. I expect it'll be much more than that and take at least 2 years to complete the raise. So that's a pretty good path for TLT in terms of debt growth, which again is bullish for bonds. Here's the SPY. Okay, last time we had unemployment and things of this nature was the Great Depression, and you got yourself a big 90% crash. I think the Fed will step in and just put a bottom on the stock market at some point before we get that low. But if you assume that what has occurred so far is at least as bad as the 2008 screw up or the dot-com screw up, then you have to consider that no less than a 50% crash is on the horizon. I think this is at least 10 times worse, and that we haven't even begun to grasp how bad it's going to get. So I do think we can break beyond a 50% correction, which will end when the Fed has to buy up stocks themselves. So that'll be around the time. Now, timeline-wise, I think we get one big leg down coming up into 2020, a rebound when we're able to open the economy back up because we've slowed down and really put out the fire in terms of the virus growth. But then the virus comes right back and we get another leg down into 2021. By then, hopefully, Bill Gates has a vaccine and ponies and rainbows from there. This gets much worse if we can't come up with a vaccine, which is a true risk. We really don't have any evidence that I can find that would lead one to believe that a virus will work. So they got a lot of viruses, or rather, vaccines. They have 7 vaccines at least currently in testing that successfully create antibodies in either humans, mice. But that does not mean that you can reintroduce the virus and it'll actually work. So they tried to do this for SARS, no luck. Why is it so hard to do this? Well, viruses are something like 1/10 the size of your typical bacteria. So we're pretty good at at medicines to take out bacteria, but viruses are so small, we don't know where they come from, we don't know how they work, and so anything in that size range, our science is really in the dark ages. And so even if you go look at our physics classes, what works when you're trying to predict things in stars and moons and planets and baseballs doesn't work when you go to the super small scale. So I think there's some breakthroughs in science that have to happen before we can really tackle things of this tiny size. So we got to really play it by ear in terms of trying to predict when the economic slowdown is going to finish, and just see how well society can adapt and be a little more careful about spreading things like this. Right now, Americans are totally uneducated. The Asians are all about this because they've had to deal with different pandemics in the past. They know to wear masks, they know to keep clean, they know to keep separated. So we'll see how fast Western civilization adapts. So again, $300 billion misallocated turned into $3 trillion in 2008. And you can see the cost to create this recovery by looking at the Fed's balance sheet. It was $4.5 trillion over the last decade, primarily before we came into Trump in office. Now they've added $1 trillion to the balance sheet, and I would estimate this is going to cost no less than $5 trillion in the next several years. So this bond rally could last more than 2 years, and the stock bear market could, because what happens if we print too much money? We get inflation. So we could end up in an environment where we're able to get the economy back and running. We're able to raise the trillions of dollars to keep everything operating through the government. But then the Fed has to start hiking interest rates because we get runaway inflation. And that could create a much longer downturn in stocks. So I'm not sure if this will go back to, no, this one doesn't go back. So unfortunately, if you look at that runaway inflationary period from 1965 to 1980, where Paul Volcker had to hike rates on and off for about 15 years, you had a bear market in stocks and bonds for over a decade. So that's hoping that we bottom out and have a nice smooth recovery in 2 years. Something we'll have to evaluate as we get closer to a solution. Okay, bond market, again, we were sitting pretty way at the top. My dumbass didn't have a sell. Told you guys if you had bills, take some profits. A lot of you did. A lot of you followed us all the way and held. And we lost all that profit. We didn't budge. We bought some puts to protect against volatility. The news came out later that big central banks were liquidating to cover these huge losses they had and to buy stocks to protect their big equity positions. Same thing was happening for hedge funds. At the same time, the oil market cratered. So we had a margin call that spanned across the entire globe and caused people to sell treasuries to try to protect their positions and not go into bankruptcy. Market rebounded right back up, and our forecast is as long as the deficit has growth acceleration, this has to go up, and the big banks are not going to lose money when they control the printing press. Not fair, not just. If we had it my way, we'd cut the government down 90% and abolish the Fed. But that's not the world we live in, so things tend to work backwards. How high could the TLT go? Look for us to protect our position and take some profits off the table as we approach 180, and then to look for the potential to aggressively build back into that position, as I do think this is a multi-year move. Okay, a key indicator for good for bonds, bad for stocks is if the dollar index is above really 98, I would say is where we drew our line in the sand earlier this year. If the dollar was over 98 into January, we were saying our hypothesis for the year was off. And the first clue again was China's stock market was crashing after a trade deal, a historic trade deal that was going to be extremely beneficial for their markets. And the US stock market was rallying. That's what led me down this crazy tunnel to discover that we were entering into a pandemic. Okay, so the dollar has jumped as high as 103 this year. And this caused them to essentially put out a $5 trillion line of credit to every central bank institution under the sun. And there's still just tremendous demand for the dollar. You can see that in that 100 print. So I would be willing to change my outlook to a degree if the dollar began to weaken, but I think that won't happen anytime soon. How low can yields go? We're already at record level lows on the 30-year Treasury, and we're about to double, triple, quadruple the assets being sold in this product. So in a normal world, that would spike yields. But again, the people who control the printing press and interest rates don't lose money, not when they can control the outcome. So they do have to compete with other bond markets. So the best leading indicator is looking at that German yield. So the lower the German yield goes, the lower I'll believe we can anticipate the US 30-year, which means TLT can go higher. Absolute high I would anticipate would be a negative 50 basis point yield on the 30-year, which would put you at 330 on the SPY. More realistically, we get to maybe half a percent yield on the 30-year, which puts us well above 240. So those are some relative measures. Again, it all depends on how long this lasts and when we can create a solution, which is, again, a vaccine is really the only true solution. Okay, emerging markets relative to SPY, South Korea, and China. China's in orange. China's outperforming everyone. I don't think the US is going to be too happy about that and anticipate sanctions going against investment. Right now, a lot of our money sneaks its way into Chinese companies through all these different index products. So I think that's going to have some rules changed, which will make this US ETF, which is really just a proxy into Chinese companies, which we can't audit because it's against the Chinese law, lose value. Now, if we just started to restrict capital flows or slow it down, we could get a nice move down, greater than that of the SPY. If they absolutely outlaw it, then again, we could end up with the maximum profit on these puts. So do look for a put option on FXI next week. Gold market, this is always fun to look. So in this chart, we have in the candlestick, that's your green and red right here. That's your spot gold. In yellow, we have silver. In purple, we have the SPY. And in GDX, we have our favorite gold miners. So as you can see, what's the bigger market? Obviously, the stock market is the biggest. Now the spot gold is $9.5 trillion market cap. So it's quite large, but it is a global asset. And the big problem with trying to bet too big on gold is that it's monopolized by central banks. So central banks actually don't want spot gold to rise. They just want to own all of it and force money into equities and bonds. So that's going to be a problem for getting too over leveraged in the gold market. And I do anticipate that they will dump gold and then buy it back and then dump gold and buy it back as often as they can to keep it from appreciating too much and distracting investors from where they want capital to flow. And if you think about it, gold doesn't really fix our problem now, does it? Bonds do. Capital for corporations does, but buying gold doesn't help anyone except for central banks have credibility in their currency. Regardless, we can see there's a high correlation to gold stocks, gold miners, and silver. So this is why, if we believe there is a stock crash coming, that we want to be careful about jumping the gun on any gold position. Now, the catch is gold's good at being an inflationary hedge, and it doesn't take a rocket scientist to realize if we're going to, over the course of the next year or two, double the money supply, that eventually you're going to see inflationary pressures. So I think potentially gold will be the best performing asset after a significant sell-off. Now, there are a few points in time where this diverges that I did want to point out. So I'm going to go back to the 08 crash, which again is not the same as this, neither in the magnitude, the underlying problem, the consumer behavior changes, the globalized systemic problem that we're facing now versus that period of time. And also the actions of the Fed are far different. So in 2008, they did rate cuts first. Once the money had primarily been raised and the problem was solved, then they went into QE and vacuumed up the debt, which allowed the banks to buy up stocks. But let's just look at that time period for some sort of glimpse at what could be coming. and why it makes sense to have at least a small gold position early on. Okay, so here we are leading into the most recent stock market crash. Okay, so again, purple is S&P 500. So we're going all the way back to 2007. So here we are. Gold's, you can see a high correlation between all these assets. Everything's going up. And here's where you get your little breakaway. So we had stocks start to sell off. These gold products and silver products remained elevated. And then boom, the stock market really started to sink. And you can see it took down these other smaller markets with it. Crashing. Now at this point, you can see the silver and gold miners are crashing at a faster pace than the stock market. Gold's holding some relative value here. So that's definitely a benefit for spot gold here. Now look at this. Here's where they diverged once again. So stocks are still selling off, but now all of a sudden we're starting to see a quicker recovery in silver and gold miners. And so what came next for stocks? They did rebound. But here's where you get, so gold miners were able to rebound before the stock market had, and then outperform gold and stocks in the very beginning recovery when the QE was first injected. So this move right here is really the key reason I have a gold miner position whatsoever, considering how correlated these assets are. And for quite some time, you can see gold miners really were the best investment, far better than stocks that were recovering at rapid pace, far better than spot gold, far better than silver, spot silver. And you can see it just dominating returns. So I really look forward to a heavy position in gold miners, but I think we're a bit early. Now for a brief moment, spot silver outperformed gold. We're gonna see it coming up. Okay, now stocks are starting to catch up. So we had an early move in gold miners. They're starting to lose. And now we're going into 2010, still QE, full throttle. And you get that brief moment where silver outperformed coming into the very end of this precious metal rally. And then silver really took off to the moon. So from that analysis, I would anticipate that spot gold will have less drawdown in a stock crash, that gold miners will rally before stocks. And then once you're full blown into QE, all the money's been raised, the balance sheet's dramatically grown for several years, that spot silver can take off and shine. And so that was really the top of the precious metal market, which has been just hammered ever since. Now, again, gold has continued to just kind of be right up there, having a steady return. And that's because central banks love that asset. And while they don't like to let it get too expensive, they also love to buy it when it's cheap, as it adds credibility to their currency. So here we are back to a similar predicament. Let's get to most recent time. So I'm going to skip to the recent crash. So the conditions for gold are beautiful right now. The only condition that's not is the anticipation of systematic selling when stocks sell off. Okay, here we are at current present time. And so you can see in purple, S&P 500 crashing. Gold did its job, just like it did in the last crash. But the gold miners did not hang on to their valuations. So now the big question is, if we have another massive leg down in stocks, are gold miners going to crash with it? And I would speculate that yes, they possibly will. So we have about a 10% position in gold miners. because of this, I do anticipate optimizing our put options so we don't have to sell it. We want to get that year hold, and potentially in the next big leg down, look for me to add some exposure to gold miners, as it should be the best performing asset in a rebound. Now, I do like the healthcare and the biotech because those are getting a direct handout from the government. So we'll have to be picky about how we allocate the cash we have set aside for our equities positions. And then we also have to understand with my current forecast, we're going to have a crash into summer and then a rebound into winter before the next big crash. So we're gonna have a relatively short opportunity to profit from equities. Okay, we got some questions. And then I still want to go through the news. And let's see what other charts we have. Here's the other currencies we're looking at. So we have the Aussie, the Euro dollar, or the Euro, the yen, and the yuan. And the Chinese currency is showing a little strength. They don't want to lose their buying power against the dollar as we devalue. And they have much of their assets in treasuries. But all the other currencies are weakening against the dollar. And this is when we're doing everything possible to weaken the dollar. So that's a pretty good telltale of what comes next. Oil market, again, the demand for oil is going to be crushed for the foreseeable future. And we're going to be maxing out every storage facility on the planet here in short order. So I think there could be some significant downside risk in oil. At some point, I want to have some exposure to US oil because I do think we have to protect that sector, not rely on foreigners for energy. So at some point, I think that'll be a discount potentially. This may be where we get that 90% off price tag on US oil and gas companies. So we may have to wait much longer for that than buying the healthcare stocks. Okay, now it's always good to have a leading indicator you can count on. We've seen a very oddball relationship where Bitcoin can be used to predict stock moves. And it does appear that the same big players who are systematically buying and selling stocks are also doing the same in everything under the sun, including Bitcoin. So we have seen that Bitcoin will sell off before stocks, and they will also rebound before stocks. And so it's probably the same big whales buying and selling those two assets. So from that standpoint, I do anticipate lower prices on Bitcoin and Ethereum, which I'll issue a 1% position for our boot camp. Again, it's going to be at the same timing when we might buy healthcare stocks. Here's a look at the stocks we do want to buy, and look at e-commerce really thriving right now. But again, we can still see it's systematically being sold off with all the other assets. So even though these sectors should have profit growth and revenue growth, unfortunately, there's still a lot of systematic selling that could take them much lower. So my hope for those is to get them this summer, sometime after we come out of a 60-day lockdown. Okay, go see if we have some new questions real quick, and then we'll look at the news. Logan says, look at what McDonald's just posted. Yeah, they're not going to buy back stocks anymore, right? What would trigger the market to sharply down? I looked at many charts and they're bouncing already. If there's a crash, I'm going to lose equities that I sold. So when will it crash? How deep in your opinion? This could be a repeat question, but I'll give you my attention. Yeah, and where I think it's going to crash for the next 2 years and greater than 50%. My expectation is we have a sharp sell-off that bottoms out around August, and then a good rally into the close of the year where we reopen the economy, but then we find out that unfortunately the virus is spreading again. We have to go back into some sort of economic contraction, and that's going to give us another big leg down. That's going to catch people off guard. because a lot of people think 50% is the maximum drawdown that is possible based on the last 2 crashes, but I would argue that this is far worse than that. So yeah, the sell-off's just going to be just a general pressure of people selling. So think about all the people passing away, all the unemployed people are going to start selling their assets to keep above water. At the same time, profits and earnings are going to be dropping, not rising. So there's really no good reason to own stocks right now. Bill says Fed just dropped rates to 0. Murray, can gold miners rally if virus shuts down miners' money? Yeah, Murray, so we just looked at that example. And so normally it's rate cuts, then QE, not rate cuts and QE. So typically I would wait for the stock market to bottom or get near a bottom, and then for QE to come in for me to give you that gold mining recommendation. And we saw that it can greatly outperform equities in the early stages of a recovery. And then after a year or 2 of that, we can see spot silver take off. So that's really the timeline on those 2. But today we're doing QE at the same time. So yeah, I do believe gold miners could get cheaper, and that's why we have our puts to protect us in case that happens. And I will add some more puts for us to protect that position potentially next week. And yeah, they could be shut down, and that's another risk. In fact, I believe many of them are currently shut down. But that doesn't mean their business model isn't beautiful and that they're not going to have a very lucrative business in the coming years. So we'll want to buy that on any dip, or rather sell our put on any dip and hold our position. Okay, great. I'm going to go into some news.
Hey Jay, look like Aaron's running out of time to do his presentation.
Oh shoot, I forgot Aaron's on today. Hey Aaron.
He said he has another webinar to go on. Maybe we could reschedule him tomorrow or get him on real quick.
Do you want to go now, Aaron? Sorry, I've totally spaced that.
Oh, no worries at all. I mean, hey, it's your show. Whatever you prefer.
Yeah, we could put you on now. I think the news, we're all pretty up to date on the news. So let's go ahead and switch to some tax saving strategies now, guys.
Sweet.
All right. Thanks, Jason.
Thank you, Aaron. Sorry for going too long.
No worries.
Yeah, I was like, we're going to have to get in on this before the news starts.
Okay, great. Okay, guys. So we're going to teach you how to reduce those tax obligations now with an expert. Thank you, Aaron.
You should be able to grab the screen, Aaron.
Yeah, there we go. All right. So perfect. Thank you, guys. So just a little introduction about myself. My name's Aaron Sofer. I'm an attorney with Anderson Business Advisors, and we specialize in asset protection, tax mitigation, and estate planning for traders, real estate investors, and small business owners. And so this is inherently a very important issue for all of you guys to be cognizant of all the issues and matters that are out there, these looming dangers, landmines, if you will, that are out there that can potentially obliterate your business, okay? Now, you may say, well, hey, I don't have a business, all I am is a trader. Well, that's not true. What you guys are doing is, in fact, engaging in a business. And so it's going to behoove every single one of you to pay attention to some of these concepts, these macro concepts that I'm going to go over in the next 45 minutes or so. And then what we also have available for you guys on this webinar as clients of portfolio builders is there's going to be a link in the chat box that is posted. Now, I think I heard Zoom is kind of buttoning up what you're able to access and link through the chat box. So you may have to just copy and paste that link into your web browser rather than being able to click on it directly. But nonetheless, you're going to be able to utilize that link to schedule a one-on-one consultation with our strategists and business advisors to go over the specifics of your individual circumstances, your individual scenarios. Because again, while I'm here on the webinar for the next 45 minutes, I'm going to talk about these broad concepts that are going to be applicable across the board. But then in the one-on-ones, you're going to be able to hone in on the issues that are particular to your individual scenario. Okay. So just brief background about Anderson Business Advisors. We are a law firm. We've been around we just celebrated our 20th anniversary last year. We work with clients all throughout the country and internationally. All right. And notably, all of us attorneys, we are all investors in the stock market, in real estate ourselves. So we employ these very strategies that we teach to our clients. We employ them in our own business dealings as well. Okay. On top of being a law firm, we also did acquire a tax practice about a decade ago, and we do offer in-house tax services because we noticed that at the beginning, we would give legal advice, these strategies to our clients, and then say, okay, make sure your CPAs are on board. And then they would take their information, their new strategies over to their CPA, and their CPA wouldn't have any idea as to how to implement what the strategies from a tax perspective. And so we noticed that was a big boondoggle, if you will. And so we just therefore acquired our own tax practice. That way there's no bouncing around, no more ping pong. And so it's all under one roof. And then on top of that, some retirement planning. So we do also have a financial services arm as well that deals in insurance. And, you know, I'm not talking about term insurance where you get a term policy 15, 20 years and 99% of those policies expire worthless. No, I'm talking about whole life insurance or index universal life insurance policies. These are additional metrics or additional mechanisms by which you can free up additional capital to invest, and essentially you can be your own bank once you've implemented these strategies. And again, we can go into much more detail in your one-on-one consultations with our strategists, with our advisors. But, you know, when it comes to asset protection, you know, it's not a one size fits all, albeit they make it look really good. Well, okay, I say that with a grain of salt, to each their own. But there's no one size fits all strategy for asset protection. And so a lot of the times, you know, there's barriers to getting the appropriate knowledge. Namely, you know, I'm sure some of you guys out there have had the quote unquote pleasure of retaining legal counsel, paying an attorney an hourly rate. It's not cheap by any means. And so again, that tends to be one of the largest barriers to getting the appropriate knowledge is the cost factor. Okay, and so that's why I'm gonna essentially demystify a lot of those hurdles or just the misnomers that are out there, floating out there, you know, on the internet, professed by these self-proclaimed asset protection gurus out there on YouTube University. And so again, I'm going to talk broadly about what some of the most important concerns there are for you guys specifically as traders. Okay, so when it comes to knowledge, the source of knowledge is incredibly important. Just like you wouldn't get on a plane that isn't piloted by a licensed pilot, why would you take asset protection advice from somebody who is not a licensed person in that field, namely an attorney? Okay, so just a little bit of background about myself. Prior to joining Anderson about 3 years ago, I was in general civil litigation. So my job was to go out there and sue businesses, private individuals on behalf of my plaintiff clients to obtain judgments of money because of damages that my clients had suffered. Now I'm working on the flip side. All right, I like to refer to it or liken it to preventative medicine. I know what the strategies I employed on the opposite side of the courtroom. So now I'm able to take and implement those strategies and work from the ground up to appropriately structure my clients to avoid those lawsuits, to avoid overpaying in taxes, and then to avoid having to force their loved ones when they do pass away, because look, it's not if, it's when. So when it comes to estate planning, it's going to be very prudent for you guys to put a plan in place while you're still alive. All right, just putting it off on the back burner on someday island, you end up doing yourselves a disservice. Well, not yourself because you'll be dead, but it'll be your loved ones. You're going to do your loved ones a severe disservice by not having a plan in place, because then they're going to have to go through the probate process. I wish that upon nobody. I did a lot of probate work prior to joining Anderson. I know how tedious and time consuming and expensive it can be. And there's a giant industry out there of probate attorneys that have a vested interest in telling you otherwise, but we can avoid forcing our loved ones to go through a probate upon our passing by putting in simple mechanisms in place, namely a living trust, which we'll talk about more in just a few minutes. But yeah, those are the few areas that we are most concerned about as investors, as traders, as individuals that are out there investing our money, growing our net worth on the front end. We have to be aware of all these issues on the back end. All right, it may not be as sexy as reading some of those charts and taking a look into your crystal ball to try and predict what the market's going to do next. But in my opinion, it's just as important. Okay. So when it comes to asset protection and tax mitigation, it's applicable across the board to every investor. So now some of the things that we have to be aware of when we get sued. So if we are subject to a lawsuit, classic example, you hop in your car driving down the road, you hit, let's just say you rear end somebody, the accident's 100% your fault. Okay, yes, you have insurance. However, your insurance, assuming that the claim is covered under your insurance is capped at a certain level, meaning that if the if the plaintiff obtains a judgment against you for crashing into them, they get a monetary award. The average personal injury judgment right now is about $1.2 million. And then the average insurance coverage is only about $500,000. So that leaves a deficiency judgment of about $700,000. Well, in that event, that plaintiff is going to be able to come after you for that deficiency judgment in the amount of $700,000. Any asset that you own in your personal name is going to be subject to that judgment. Okay, so again, that all it takes is one accident, and all of a sudden, everything you own in your personal name. So if you have your brokerage account in your personal name, that is what we like to refer to as low-hanging fruit for plaintiffs' attorneys, because that is a very valuable asset that can simply be garnished or seized by a court to help offset the amount of that deficiency judgment that you owe to that plaintiff. Okay, so these are just some assets you'll see up there on the screen. This is an advertisement that's put out by an asset locator firm that plaintiffs' attorneys use to qualify the defendant, right? You don't see plaintiffs going out there and suing homeless people because there is nothing to get at the end of the day. So when I just used the term qualify the defendant, when a plaintiff comes in or a potential client that wants to sue somebody comes into my office or used to come into my office, the first thing I would do, rather than going and looking up the law, because I already knew the law, I had to go and do research on the potential defendant to make sure there was something worth getting at the end of the day in the event that we did proceed with the lawsuit. If there's nothing to collect, the lawsuit, even if you obtain a judgment, the judgment's not even worth the paper that it's printed on, okay? So that's why it's important that we implement these and we utilize trusts and business entities to get these very valuable assets. So in your case, these brokerage accounts, we get these assets out of our personal name. So it's no longer us that owns these accounts personally, rather we retitle these brokerage accounts and have them held in business entities, okay? And I'll go more in depth on that in just a moment. But again, as investors, we have to be aware of those threats, these legal liability claims that are looming out there, okay? They can emanate from personal injury. So again, that car crash scenario, that's the classic example there. And the reason it's a classic example is because it happens all the time. Property ownership is another big one. So if you happen to own rental property or something like that, even your own home, any accident that occurs on that property and you own that property, well, you as the property owner, you're going to get sued. Then additionally, we have to be cognizant of our children, okay? Hey, we love them, but they're huge sources of liability. All states have laws on the books that refer to family purpose doctrine. So if one of your children is out there and engaging in some sort of act in furtherance of some household purposes and some damages are suffered as a result of the act of that child, guess what? Parents are going to be held liable. All right. And then contract claims, loan defaults, and bank concerns. So if you personally guarantee a loan, whether a mortgage or a student loan, and that borrower defaults, well, guess what? You are now going to be liable to cover that amount in default, those deficiency amounts. So it's imperative that we're cognizant and that we start to take these assets that could be used as a source of recompense to those creditors, those judgment creditors that obtain a judgment against us. We start to take those assets out from underneath our name. So no longer are there so many available avenues of recourse to those plaintiffs. You make it less likely, you reduce the size of the target on your back by taking these steps, by removing these otherwise very valuable assets that were previously owned in your personal name, and we move them and we put them over into business entities. Because the three basic rules are, we don't want to own anything in our own name, because again, that can be used, those assets can be garnished by our judgment creditors. We don't want to do anything in our own name, because when we sign our personal name, as opposed to signing on behalf of a business entity, say the president of a corporation or the manager of an LLC, if instead we just sign our personal name on a contract, then we incur that liability personally. Okay, so these are concepts that I know may not be so native to many of you, but again, I'm covering all these in broad brush strokes. So I introduce you to these concepts, and then when you sit down one-on-one with an advisor, we can go and get into the nitty-gritty and explain to you just how specifically it's going to work in your circumstance. Okay. And then lastly, we don't want to own any assets where we conduct a business. So it's kind of a change of mindset. All right. No longer are we doing everything as an individual, as a sole proprietor. Instead, we want to go ahead and conduct those business endeavors in business entities that inherently have liability protection. Okay. So now three of the challenges, we've talked about two of them. Again, the first two challenges, knowledge and lawsuits. The third challenge is mitigating that tax bill. Okay, there's that old saying, it's not how much you make, it's how much you keep, right? If you're overpaying in taxes, it can be just as punitive as being the defendant in a lawsuit, as getting the wrong information from the wrong sources. Okay, so making sure your tax bill is as small as possible is just as important as those other areas. Okay, and so how we take steps to mitigate our overall tax bill, we employ this strategy called income shifting. Okay, and if you don't believe me as a licensed attorney, by all means take it from these judges that have gone on record saying, and how awesome of that is the name learned hand for a judge, right? But he went on to say, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the Treasury. There's not even a patriotic duty to increase one's taxes. Guys, case in point, our president, politics aside, his business structures, Newsweek did a expose on his business entity structure. This was probably about 3 years ago or so. And he employs these same exact strategies that we at Anderson Business Advisors, those same strategies that we employ and implement for our clients. Okay, it's all about income shifting and using different taxpayers. Okay, because when we create a corporation, for example, a corporation is a separate taxpayer altogether. Some of you may recall Mitt Romney back in 2012, he got absolutely panned for making the statement, corporations are people too, but they 100% are. They have personhood under our laws. And so by creating a corporation, we've created a separate taxpayer that, especially in the case of a C corporation, there are different types of corporations, a C corporation being one of them. When you create a C corporation, it is a separate taxpayer that pays a flat federal tax rate of 21% on all income that it generates. You compare and contrast that to us as individuals. Well, our individual marginal tax rates range between 0 and a top marginal rate of 37%. So if you're a high income earner, I mean, you could probably already start to garner that there's some planning opportunities there. Whereas if between your state and federal tax rate, if you're in the highest income tax bracket or even the second highest income tax bracket, you're paying anywhere from between 45 and 52% on those dollars that you earn in excess of those income thresholds. So instead of earning those dollars, just to finish that thought, instead of earning those dollars in your personal name that would otherwise be taxed at almost 50 cents on the dollar, we can have those dollars earned by another taxpayer, namely a corporation that you still own and control. And then you reduce your overall tax rate. Again, income shifting. And then the second quote on there, Justice Rehnquist from the Supreme Court, there's nothing wrong with a strategy to avoid the payment of taxes. And mind you, that's avoid, not evade. Big difference. There's a small difference in sound, but big difference in interpretation and implementation. So the Internal Revenue Code doesn't prevent that. And we're all about tax avoidance, right? The Internal Revenue Code, it's about 4 million words. We don't have to know every single word. We just have to know, a few ways to the other side of the minefield by which we reduce our overall taxes. So as traders, some of the tax concerns that you should all have and be aware of, this Obamacare tax, also known as the net investment income tax, 3.8% additional tax on passive income, okay? And that tax kicks in if you're an individual. So you file your taxes as single or head of household, that additional tax kicks in at 200,000. If you're married filing jointly, that additional tax kicks in on investment income earned over 250,000. Okay. And then if you're trading out of your individual name, you have to list all your individual trades on Form 8949 and close that with your personal 1040. And then on top of that, whenever you trade in your own name, you're going to, just as a matter of principle, you're going to be you're going to have increased scrutiny by the IRS because of the fact that you're trying to take deductions on your personal 1040. And so when we're engaging in trading in our own name, it can be very expensive from a tax perspective, okay? Completely disregarding the lack of asset protection. Purely from a tax standpoint, it is very expensive to trade out of your own name. All the income is unearned, meaning even if you make $1 million in that year from trading stocks, again, it's unearned income. You can't even make a contribution to an IRA. You need earned income to make contributions to a retirement account. And then additionally, if you're trading out of your own name, the IRS has come out and said you're not allowed to take deductions for educational educational endeavors or offerings or seminars. Okay, so case in point, the money that you may have paid to portfolio builders, that would otherwise be a non-deductible expense to you as an individual. However, we can take some steps to make that otherwise a deductible expense. And so additionally, as an individual investor, you don't get to take those additional deductions for equipment, computers, other trade-related expenses. As of the Tax Cut and Jobs Act of 2017, no Schedule A miscellaneous itemized deductions. So that definitely has some impacts, even for those of you that may have been trading out of a business entity. If you're trading out of a single member LLC, no longer are you going to be able to write off a host of expenses that you were previously able to do so pre-2017, okay? And then again, no asset protection. So you get in that car crash, it's your fault, there's a deficiency judgment issued against you. All of your personal assets, including that valuable brokerage account, is now an asset that plaintiff can go after, all right? So rather than do nothing, there are some people that could potentially qualify as a trader. Yes, there is a status referred to as trader status under the Internal Revenue Code. It is a very high bar to attain, okay? The trader status, it's discussed in IRS topic 429. And essentially, if you qualify, if you meet this very high bar, the IRS will let you take deductions for business equipment, for trade-related seminars. Essentially, it'll allow you, the IRS will allow you to treat your trading as a business without conducting that business through a business entity, through an LLC or corporation. Again, a very high bar to attain. In order to qualify as a trader, those bullet points are up there. These are all factors that the tax court will weigh in evaluating as to whether or not somebody is in fact a trader pursuant to the IRS definition. And again, it is a very high bar. The one example we're about to take a look at, pay particular mind to, let's see, trades on a regular and continuous basis. Okay, in Nelson in 2013, the taxpayer did 525 trades over 121 days. Okay, so yeah, he's on average doing multiple trades per day. And you might say, yeah, that seems like regular and continuous activity. Well, the court said that since he only did in that particular year, he did all those trades just within 121 days, that it's not regular and continuous through the entire tax year. Okay, so even though Nelson was a very active day trader during those periods in question, it wasn't throughout the entire tax year, and therefore the IRS denied him trader status, and therefore he wasn't able to take deductions that he otherwise would have been had he qualified for trader status. He wasn't able to write off his educational seminars, wasn't able to write off his data feeds, his subscriptions, any of that. He was not allowed to take those deductions because he did not qualify as a trader. Again, a very high bar to attain. So rather than, again, I have this thing, it's like Bigfoot, okay? You're not going to be able to qualify as a trader, right? I mentioned we have over 15,000 clients. I can count on two hands how many of our clients actually qualify as a trader, okay? Very hard to do. So rather than focus on that, the solution is we are going to use business entities, such as a limited partnership or an LLC, a limited liability company, and we're going to conduct our trading through these business entities, okay? So rather than have that brokerage account listed in our own name, we create these business entities, whether a limited partnership or an LLC, and then we open up the brokerage account in the name of that entity. And then you own and control that entity, okay? And in doing so, we're going to incorporate the use of a corporation in that business entity. And by incorporating the use of the corporation, we're now able to funnel or shift some of that income, trading income, over to be paid over to the corporation, and then the corporation inherently operates under the corporate tax code, the corporate chapters of the Internal Revenue Code. And it should come as no surprise to anyone that the most deductions, business deductions afforded under the Internal Revenue Code are afforded to corporations, okay? Even more so than the partnership tax code or the individual tax code, all right? The most deductions are afforded to corporations under the Internal Revenue Code. So the only way to take advantage of those deductions is to set up a corporation, all right? And so, as I mentioned, we're going to actually hold the brokerage account in the limited partnership or the LLC. All right, and so let's take a look at the limited partnership first, because the limited partnership has been around for much longer than LLCs. The first state to enact an LLC statute was Wyoming in the 70s. They didn't actually become popular until the 90s. And so as of the last 20, 30 years, they have now become the entity of choice just because LLCs afford the business owner, the taxpayer, more flexibility in how to structure their endeavors, okay? But nothing wrong with a limited partnership. You can most certainly still trade out of a limited partnership. And this is how a limited partnership works, okay? So let's take the example where we open that limited partnership and we open up that trading account. And so now the trading account is held in the name of the limited partnership. Let's say we create or generate $30,000 of net profit. Okay, typically we will have, and so the positions within a limited partnership, you have one or more general partners and one or more limited partners. Okay, and as the general partner, we'll have the corporation be the general partner. As I mentioned, we have to incorporate the use of a corporation into our endeavors. Otherwise, we don't get the benefits of the corporate tax code. And so typically we'll do an ownership split of the limited partnership. We'll have the general partner own 20%, okay, 20% of the limited partnership, and then the remaining 80% to the limited partner, which would just be you individually, or maybe another business entity that you own and have for passive holdings, okay? But in any case, we typically set it up 80-20 split, all right? And so then let's, for the purposes of this example, we generated $30,000 in net profit in this tax year. 20% of which is routed over to the general partner, which is the corporation, and then the remaining 80%, so the remaining 24,000 is remitted to us individually as the limited partner, okay? And so by paying that 20%, the 6,000 over to the general partner, over to the corporation, now we've generated active income. Now we can make contributions to a 401k or an IRA, or better yet, we can take deductions against that $6,000 of income that we otherwise wouldn't have been able to take in our individual capacity. Okay, so this is one way through a limited partnership to allocate the profits so as to incorporate the use of a corporation and take advantage of all the deductions available to the corporation. Let's take a quick look at the LLC. Operates very similarly, but instead of a general partner and a limited partner, you simply have a manager and a member. Okay, so the corporation is going to be the manager. And so let's put manager right here. Manager. Let's spell that wrong. Bear with me. Okay, manager and then member. And so when we talk about LLCs, member equals owner. So the member is going to be you. You still own the LLC. And then your corporation, which you also own and control, is going to be listed as the manager. And same ownership splits, 20/80. And so then again, I just have this example up here to illustrate the similarities between how the profit splits work, regardless as to whether you own your brokerage account in a limited partnership or an LLC. Okay, you still derive all the same tax benefits. But again, with the LLC, you do have a little bit more flexibility as to whether you want the income that's paid over to the member, you, to be active or passive. Okay, in a limited partnership, the income is paid to the limited partner is automatically passive. There's no option to make that active. There may be some scenarios where you want active income. Again, if you want to be able to make additional contributions to retirement accounts, you need that active income. Okay, and so these are some of the deductions that we can run through the corporation, since our corporation is part of our trading entity. All right, that's the key part right there. We have to have the corporation own a portion of the trading entity so we can then run these otherwise non-deductible expenses, had we tried to write them off in our personal capacity. By having the corporation involved in our trading structure, we can now write these expenses off. And I'm not going to run through every single one of them, but some of the bigger ones, we have depreciation, 179, we could take depreciation against our equipment. So our computers, desk equipment, we can depreciate that, take depreciation and offset the income that we generate using that depreciation deduction. Some other big ones are startup and organizational costs. And then you can even write off automobile reimbursement, which you used to be able to do on your miscellaneous Schedule A itemized deductions. Again, as of the 2017 Tax Cut and Jobs Act, can no longer write that off on your personal 1040. So the only way to get that reimbursement is by maintaining a corporation. Okay, then here's a big one right here, trading seminars. All right, since now we're running our business and incorporating the use of a corporation, we are now able to take deductions for expenses that we pay for educational and trading seminars, aka money spent with portfolio builders or anyone else, any other education provider. Okay, we have now made that a deductible expense. Big implications. So let's take a look at how that effectively works, how we're going to utilize the corporation to reimburse us for expenses that we've already covered. All right, so for a lot of you, you opened up your brokerage account in your personal name and you started trading in your personal name, but then it's okay to get these business entities set up after the fact. That's not going to prejudice you, okay? But if you wait until you're sued, then it's too late, all right? You have to have these mechanisms, these business entities, these structures in place prior to the harm occurring. Otherwise, you can't derive any protection from these structures, okay? So just to continue on through that example, so now we maintained that brokerage account in the limited partnership or in the LLC, and then we paid over 20% of the profit, the $6,000, over to the corporation. So now we're going to take a look just at the corporation and how we're now going to be able to use that $6,000 in income that was paid over to the corporation. We're going to take a look at how we can now make that tax deductible, okay? How we're going to effectively pay zero tax on the $6,000 that was paid to the corporation as the profit split in the LLC or LP, Okay, so now $6,000 is in the corporation. Let's say you've spent $5,000 in education. So you bought that pro package with portfolio builders, spent $5,000 on education. You had another $2,000 in business related travel expenses, and then you had $1,500 in computer or equipment expenses. So you incurred $8,500 overall in personal expenses. Okay, this was prior to getting your trading structure set up. So this is where a lot of you guys, this is the boat you will fall into. Okay, you've already incurred these expenses personally, but now we're going to transfer these expenses over to the books of the corporation, since these are valid and bona fide business expenses. So we're going to transfer them over to the corporation and then have our corporation reimburse us for those expenses that we covered using personal dollars. Okay, so again, corporation now made $6,000. Since we've already covered these expenses personally, we are now going to have our corporation reimburse us that $6K, and then we effectively move these expenses onto the books of the corporation, okay? Because these are valid and bona fide business expenses. So then we took an $8,500 expense, and then we had 85,000 or 8,500 in expenses. Our corporation had 6,000 in income, and now our corporation reimbursed us the 6,000. Since it's a reimbursement to us individually, it's not taxable. It's not income to us individually. A reimbursement, take this example. I go out and I buy donuts on behalf of my law firm, and I spend $20 buying donuts. I bring those to the office. Anderson, my law firm, they reimburse me the $20. I don't have to claim that $20 of income. It is a reimbursement, and Anderson takes the business deduction as a meal expense, okay? Same idea here. Corporation reimburses me that 6K, and then I'm in this example, I still am carrying $2,500 in additional unreimbursed expenses. Let's say the corporation makes an additional 3K the following year. Okay, what do you think the corporation is going to do once it has that $3,000 in income? It's going to turn around and reimburse me $2,500. Okay, so now my corporation doesn't owe me anything because it's reimbursed me for all the expenses that I covered personally. And then that leaves just $500 in taxable income left to the corporation after making that reimbursement. Okay, so again, we can only practice these types of income shifting strategies by utilizing a corporation. All right, so let's see, I just have a few minutes here, so I just want to get to the other important section that I want to make sure to cover. In setting up the business entities, we are going to go to one of the 3 states that you see up on here, Wyoming, Nevada, and Delaware. As business owners, which is what each one of you are, as business owners, these states provide us the best asset protection and tax mitigation, okay? And so we'll typically go to one of these 2 right here, Wyoming or Nevada, just because Delaware, hey, nothing wrong with Delaware. Delaware is a little bit more expensive. And typically you go to Delaware if you're going to take a company public. If you're a small business owner, then you're going to go to Wyoming or Nevada. Wyoming has the cheapest cost of filing, cheapest cost to maintain an entity. So that's why we typically gravitate to Wyoming. But at the end of the day, nothing wrong with any one of these 3 states. So that's where you will typically have your limited partnership or trading LLC set up, is in one of these 3 states. Okay, so here's a plan of action real quick. We want to make sure that we get the entity set up. Again, if you don't have the entity already in place when you get sued, it's not if, it's when you get sued, then the entity provides you no protection. And so once you have that limited partnership or LLC set up, you're going to open up a brokerage account directly in the name of that business entity. You can roll over your existing positions into the new account. Then we need to create that corporation to be the general partner of the limited partnership or the manager of the LLC. And then once we start generating profit in the trading business entity, then we can pay the management fee over to the corporation. Remember that 20% theoretical. I mean, you get to determine what it will ultimately be, but we typically use 20% as a rule of thumb. Okay, so then the last facet that I want to stress upon today with you guys is the estate planning portion. Okay, down there at the bottom of the screen, you see the living trust. You can think of a living trust as a suitcase. Whatever assets you put in that suitcase are going to be covered by the terms of the trust. Okay, trust, there's a trust agreement and it operates as your estate plan. You get to dictate and determine how distributions are going to be made, who's going to serve as your successor trustee, who the beneficiaries of the trust are going to be. You do not have to be a millionaire or billionaire in order to warrant having a living trust. Okay, that's what I mentioned before. There's a whole slew of probate attorneys that will have you think otherwise. All right, but that's because they earn a percent, probate attorneys earn a percentage of the estate on the back end when they probate that estate. You can allow your loved ones to bypass the probate process completely simply by having a living trust in place, okay? And so then once you have the living trust drafted and you sign it, then you put the assets inside of it. So then you'll assign your ownership and all your various other personal property. You'll assign that over to the living trust. So that way the living trust is the ultimate owner of those business entities and of all those assets. If your trust doesn't own whatever the asset is, it can't flow through the trust. Okay, so the trust has to be in existence and it has to own either directly or indirectly all your assets in order for those assets to be interpreted or be distributed according to the terms of the trust. All right, I do want to touch really quickly on retirement accounts. All right. With your retirement accounts, that's a fantastic way. I mean, depending on whether you're using a traditional IRA or a traditional 401k to invest, those are your tax deferred accounts. But you can also trade through a Roth, and that's you're paying your income tax now, so you're not getting an income tax deduction in the year in which you make the contribution to the Roth account. But the trade-off is you'll never pay tax on any of the gains in that Roth account ever again. All right, so there are definitely some things that we can do to ultimately protect your retirement accounts, even more so than they may already be protected already. What I mean by that is IRAs. The protections afforded to IRAs vary state by state. It varies by your state of residency. Not all states protect IRAs equally. There are a handful of states that simply don't protect IRAs at all, meaning that if you get sued, then your IRA can be a source of compensation, of recompense to that plaintiff obtaining a judgment against you. All right, so what we like to do with our IRAs in many cases is roll those over into 401ks. You do get a little bit more protection from 401ks because a 401k is a qualified retirement plan. It's qualified under ERISA, which is a federal act, the Employee Retirement Income and Securities Act of 1974. So we always want to rely upon federal protections more so than state protections whenever feasible, okay? So I know there are a couple questions. Let me see if I can get to those real quick. All right, and let's make sure that the link gets posted in there too. Let me see here.
Yeah, and so it's really weird. Zoom stopped using like a hot link apparently sometime between Monday and today.
Okay.
But we did post the link in the chat that says make sure to book your appointment with Aaron to reduce your capital gains exposure and minimize risk. But it says copy this link to your browser now, but the link is in there.
Okay, I see it. Perfect.
Yeah, so guys, you will just have to copy and paste that link into your browser. I'm not sure what happened, but unfortunately, Zoom is not allowing a hot link. And when I say hot link, just we used to be able to post a link into the chat box, and you could just click it and then go from there to the page. But just copy and paste the link in there into your browser, and that will work. Okay.
Perfect. All right, guys. So I'm not seeing any questions in the chat, but by all means, use that link. Schedule the one-on-one consultation so that way we can get into the specifics of your scenario to make sure that you are going to be not only protected from lawsuits, but not overpaying taxes, and then responsibly leave the assets which you're working so hard to grow during your lifetime, so that way you can responsibly pass them on to the next generation. All right, so yeah, that concludes my presentation with y'all today. I'll hand it back over to you, Jason, if you got any final points you want to make over there.
Okay, thanks, Aaron. Appreciate it. And I'm not sure if Jason is back in at this point yet, But let's see here. You just got a question from Donald Dickey. Says, question, I have a trust. Would the trust own the LLC?
Yes, potentially. The trust would own the LLC, yeah. So how you could think of a trust is it's your alter ego. So wherever you individually show up on title or as the owner of an asset, then you would want, once your trust is drafted, then you would want to assign the ownership over to your trust. And then I see another question, why do you charge more for Wyoming versus Nevada? So it's not us as a firm charging more for Wyoming versus Nevada, it's the difference in states. Okay, so as we know, each state has different laws. And so inherently each state charges a different fee for different entity types. Okay, it's not uniform across the country. And so, I mean, states have different reasons as to why they charge differing prices. Nevada, their justification for charging more was that they had dedicated business courts. So they have judges that only hear business matters, business issues, as opposed to other states where if you're in civil court and litigating a business matter, you very well may have a judge presiding over the business litigation that just yesterday was presiding over, you know, some family court, you know, a divorce proceeding or something like that. So there's very good reasons as to why, if you're actively involved in business, you'd want to go to a state that has business owners' best interests in mind. And so that is one reason why Nevada used to charge more. But now Wyoming, they implemented the use of business courts just as of their last legislative session last year. So Wyoming, they're a lot cheaper than Nevada. They're about a third of the price. And they now have roughly all the same benefits as Nevada. So that's why I said we tend to go more towards Wyoming, simply because for our clients, it is cheaper to administer.
Nice, very nice. Okay, cool. I believe there's a little more anonymity from what I learned from you as well, Aaron, on Wyoming compared to Nevada.
Yeah, and so very good point there too. Wyoming, they don't even, if you have an LLC, they don't even publish who owns an LLC. It's not public information. Where you can still do something similar in Nevada, but Nevada, they have to publish a name in connection with an LLC, but it doesn't have to be your name. So what I mean by that is you can use a nominee in Nevada so as to still maintain anonymity. But yeah, a very good point there. Wyoming, they don't even publish that information. So, you know, we tend to gravitate to Wyoming just because of those multitude of factors. Yeah.
Okay,
all right,
great.
guys. Well, if there's nothing else, I will go ahead and run. It's been a pleasure. I look forward to speaking with you. Make sure to use that link so we can get linked up, and then we will make sure to get you guys structured. All right, I will be on my way, and I'll look forward to speaking with each and every one of you soon. Take care.
All right, thanks, Aaron. Appreciate it.